We have a small crowd today, so I'll keep it relatively short. But last week, said that we're going to cover equities and the Bloomberg functions. However, off of this computer, I'm not able to access the terminal. So I decided that I'd push that one to the last one. That way I could get a few days to come in here and actually figure it out before I try to teach it. So right here, this is the certificate. If you did all the modules, you're able to complete this. I think there's only 4 required. I think we have like 3 or 4 left that we're going to get to that aren't required for it, but are still covered. So equities, there were I think 5 little modules: introducing the stock market, nature of equities, a little spelling error, but there's also absolute valuation and relative valuation. In the introducing the stock market, it pretty much just gave all of the basics, like what is a stock, an equity, a share, pretty much talking about all the same thing. It's the primary source of financing for large and medium-sized corporations. Part ownership is referred to as stock, share, equity. And when a company goes public, it's called initial public offering. That's how they raise money and transfer ownership. And the main thing that they were trying to convey is that no one is able to predict if stocks go up or down. I feel like they had that as a little financial disclosure, so you weren't yelling at them when you lose all your money. But through absolute and relative valuation, you're going to be able to make better financial decisions. So right here, we have the index weight. These were included on the modules. It walked you through on pretty much how to tell if a company, how much it's weighted in the market. And it explained what market cap was. It's pretty much all the outstanding shares. It walked you through Apple and I think Microsoft and a few other companies through the modules. And with the nature of equities, shareholders own shares that pretty much give you access to the earnings and assets of the company. So through owning a share, you'll be able to attend the shareholder meetings, gain access to most of their financial records, and join in on like conference calls and things. And stocks are really volatile because the earnings are volatile. So I don't know a recent one, but I think it gave Ford as the example, how Ford had really positive earnings, I think in the 80s and then like 90s to 2000. Might be getting the years wrong, but their earnings went under. And it was explaining how the share price, of course, follows really closely with how the company's performing and how their earnings are doing. So shareholders can gain a return through dividends. Most people that pay dividends, or most companies, are the, I guess, titans of the stock market. So you think like Coke, Waste Management, companies that really aren't going anywhere anytime soon. Although a lot of the companies that do pay dividends are kind of on the decline. Someone in the investment society meeting was talking about the life cycle of a company a few weeks ago. And typically companies that are older, more established, are paying the most dividends. With dividends, you want to make sure that a company has had a long track of actually paying them, and their dividends are going up over time. So also talks about pretty much how stock works. The outcomes are asymmetrical. So if you're just investing in the market, of course, your shares can go to zero. The company can go bankrupt, completely disappear. But the value can go endless, you know. It can go really high. You can make multiples of money off that. So really, in the case of shares alone, you're only really losing what you put in. Equity research. So analysts must know the industries in which a company operates. So think like tech, food, retail. These analysts are, they're researching these industries before they make their decisions. Think like retail during COVID. People were shy of that. Airlines, people didn't want to go into those industries. So these are what they're looking for. And industry drivers help formulate earning estimates. Investors assess company results by comparing them to estimates. And then the absolute valuation and relative valuation ones. These little units were really long on the modules, but it walked you through how to do a complete absolute and relative valuation on different companies through a bunch of the functions that I have later in the presentation. So this is going to be pretty broad because the way to actually do it that they showed you took tons of different functions in the Bloomberg terminal. So just going to be pretty much covering the principles of it. So absolute valuation involves the discounting of future cash flows, and future profits in the long term are worth less than future profits in the short term. Good financial models balance simply with insight, and then the concept of absolute valuation is theoretically perfect, and the outputs from absolute valuation are usually precisely wrong. As compared to relative valuation, it's a quick and easy comparison of one valuation to another. The risk of relative valuation is being led astray from unrealistic references. And earnings and multiples are used to estimate fair share prices. Fast-growing companies warrant high multiples and vice versa. And the state of the economy is a key driver of relative valuation. At the end of the module, when you completed it, these were the key concepts that it gave you. Pretty much the takeaways of the modules. Index movements are driven by movements in member stocks. The volatility of earnings lead to volatility of share prices. Uncovering industry drivers is key to estimating earnings. Absolute valuation is in theory perfect, but has practical limitations. And relative valuation is easier, but sensitive to earnings growth.
And the second point, you might research in several college papers or academic papers written where stock price is more volatile than earnings. So professors should try to figure out his PhDs.
So
is the volatility of the stock warranted by the volatility of earnings?
That's what recently I've been trying to read like all the classic books, The Intelligent Investor, Random Walk Down Wall Street, but pretty much all they're saying is that like right now with how the market currently is, it's not making sense. So like think of Tesla, for example.
Yeah.
Their market cap, I think I saw a graph on it the other day, makes up all the other major automotive industries, all their market caps together. And their earnings on the graph were minuscule to that compared to the other ones. But then you have these weird factors where, you know, Tesla's not a car company, as they're saying it. It's an AI, but how do you value something that isn't really sold or profitable yet? So that's where volatility is really questionable in the market right now as far as share price.
Yeah, I did analysis of them. If they sold every car in the world, they would still be a little expensive. Their valuation per car sold.
For like every car on the road being sold right now?
Every single car in the world, you did the valuation per car, it would be more expensive than, they wouldn't be the most expensive, but they'd be more expensive than Ford and GM.
Well, now they just,
they're going to be 100% of them.
They just did $1 trillion market cap too.
Oh yeah.
yeah, they just, with the Hertz deal, just
Yeah.
skyrocketed.
$4.2 billion deal for Hertz. Was just going bankrupt like 2 years ago.
So are they going to sell something besides cars? Yeah, it was a good article that said all the EV car companies, they make sense, but everyone's being valued as if they're going to dominate the market, which is not possible.
Mm-hmm.
Mm-hmm.
So
Totally.
the market's like they're all going to succeed, but they can't. You have to figure out which is going to fail. But yeah. And
Yeah.
can you go back to the slide? Well, I haven't done the equity yet. I'm still working through fixed income, so I'm not going as fast as you. Keep going back. It's the yellow box.
Oh, right here.
I'm trying to figure out what they're doing here. All right, first one they say Apple's 4%. That's a few years old, but 4%. I couldn't figure out what the second one was.
The second chart.
So what they're saying is Apple's stock movement, how it impacts the index movement. Is that what they're saying?
Mm-hmm. Pretty much, it's like total weight on the market as it's growing. I think it gave you like 2012 and like 2016 or different years. And
I've never heard points contribution of Apple. Was that the term they used?
I think that was their how much of the market that they're in right now.
I'm still working through. I just do it at breakfast, which is like, 15 minutes a day.
Well, it surprised me. The first ones, whichever one was first, like economic indicators, that was really easy, and I was like, oh, this is gonna be a breeze. And then the equities one, it took a really long time.
Well, Colin's gonna write a paper 3 and 4. You might want to write 3 and 4, and then see what Bloomberg would do. Their models are any different from what our models are.
Yeah.
What else did I have?
Okay, I'm eager to get to. Oh my word! Yeah.
Yeah, these were all the functions as I was going through for the absolute and relative valuation. They probably used most of these for both of them, and
I used a lot of those, but some of those.
I'd be here for an hour if I was trying to walk
like
through.
EBTS is good. That's where you can do the conference call. And EEG is good. Yeah, we've used quite a few of these. WEI is usually what I start with. I like the ones where they have everything, and they have the same thing on the bond market. And have everything you can start picking down, and that's pretty cool.
Completely.
You got in the WEI before.
I haven't. Most of my investing is I prefer, like, I don't have access to a lot of these things, so I'll find someone I'm confident in. For example, I got into ARC, led by Kathy Wood. It's an ETF. Pretty much, if I can let.
The really concentrated one.
Yeah, it's a tech industry one, so
I've heard of that one.
not too confident for a really long while, but it's got a good return. But I think it was Warren Buffett that said, he was like, when he dies, his wife's trust fund, wherever he puts her money, is just in an index fund for the S&P 500. Said if you can invest in one thing, that would be it.
Yeah, I'm pushing more to small cap, but yeah.
So these are all the terminal functions, and everyone here is in the group me right now. Let me hide this.
You got a couple people online.
Perfect. So next week, we're going to cover commodities and equity options. I should have just covered the equity options here. I was planning on doing it with terminal functions, but like I said, I would rather be able to come in here before and practice. That way I'm not just coming up here and teaching without doing it.
Great derivative functions on the options and on swaps, on futures. I guess I don't know if they cover swaps at all, but they got a really great swap function. Good. Well,
perfect. Right here, everyone signed up. I know we had some people last week, so I decided to make a page for this. But if you're not actually signed up, you can't see my cursor, but right here it says use your UTSA and email address to sign up for BMC. That's what you're going to click on after you Google UTSA Bloomberg Market Concepts. And it should be pretty simple from there. Just use your new email to sign up for it and be able to start the modules. It's also pretty cool. There's on Bloomberg, I have it bookmarked, so every time I click it, it goes to the home page, and with your account, you have access to like a bunch of news articles. It's really similar to like the Wall Street Journal as far as like how many articles you're able to choose from. It's a good amount for I'm not really paying for anything, so definitely recommend getting signed up if you haven't already. And
they have a good TV channel. Yeah, they do a good job.
Yeah, they make lots of those short little videos, just like the modules, where it's just like watch like 3 15-second clips to get a good idea of what's going on. So that's really all I have right now. Go ahead and end the meeting. I appreciate you guys for coming.
Oh, you can hear me? Okay. So I'll go ahead and get started right now. It's just you. Did you get my email that I sent out?
Yes, I got your email.
Okay. All right. So today, I don't know if you really had a chance to look at your firm or the industry, but what I'm going to talk about today is Porter's 5 forces, and you probably are covering this now? Or
Yes,
yeah.
I have. Yes.
Okay. Well, the reason I want to talk about it is because, we actually use it. I used it in my report, when I was talking about a firm at Victory. And, it's kind of important to think about as we're looking at these firms and trying to analyze them, right? So in class, I think you don't really apply it to any firm. It's kind of, you're just learning about it. So I think that this will be helpful. Today, we're going to just go through it a little bit. And then also, do you have any questions, or as you're looking through the firms, like, have you noticed anything that you want to talk about?
Well, I was looking at the credit rating for the Martin Marietta and the Vulcan Materials,
Okay.
and they both were doing the same thing. I mean, they both have the triple B rating,
Yeah.
and they both had acquired like a little company through debt. So I was just reading about their leverage and stuff, how it affected the debt and stuff. So
Awesome. Yeah. So that's, I mean, from what I saw, the acquisitions are pretty, it's pretty frequent in that industry, right? So I think they do that to reduce the competition, right? That's kind of what it seems like. But have you seen anything else, or?
not really. I mean, I just read more about Vulcan Materials.
Okay.
I got they had bought this company to expand on the East Coast and then part of California.
Yeah.
So they were just getting market share through that.
Awesome. Yeah. Well, as you see, yeah. And then that's also, so their triple B rating, right? That comes from their high revenues, right? Their good management of debt. I'm going to talk about that a little more probably next time, how we can look at the industry and kind of come up with a baseline model for, where should we rank their revenues. Let me see if I can, let me talk about Porter's Five Forces real quick, and then I can cover that with you since you're the only person here right now.
All right.
So as far as Porter's Five Forces, right? So we're looking at competition in the industry, because competition high or low. One of the main things, obviously the main driver is going to be, revenue. That's really highly ranked in, the credit ratings. So, that's something important we should look at. The potential of new entrants. So are there high barriers to entry? For some of the materials, there would be a lot of startup costs, right? So that's something we need to look at. Also where's the government at? Do they support, this expansion? For example, as far as gas, right? Right now, current administration is leaning more towards sustainable energy, right? So where does that, or how does that affect, our industry? Power of the suppliers. So for example, we talk about the cost of lumber, right? Back in May, so it reached a peak of $1,683 per 1,000 board feet, and now it's back down to more normal levels of $637 per 1,000 board feet. So in this case, right, if we have a home builder, or in our sector, if we have a company that needs lumber, then, are they facing this essentially higher demand, or what are the effects of the higher demand? They're having to pay a lot more for that lumber, right? And also, you'll see here, is this going to be something that's sustainable? Is this power of suppliers going to go on for, the next couple of years, or is it something that's just in the next couple of months? As you saw with lumber, it dropped pretty quickly because in 5 months, it's pretty much back to normal. And that's also due to COVID and, Canada. Lumber, we weren't able to get the same lumber from Canada, right? when you come into the power of the customers, is the competition fighting for a limited amount of customers? Are they fighting for some key players? And then also the way I think about it is, what is the demand for the good or service? So is it a household item, or is it something that's very specialized that not many people can use or not many firms can use? That's kind of the way I would think about it. And then finally, the fifth factor is the threat of substitute products. So are there similar products that can be used in a certain way or in the same fashion to benefit the customer? So an example is, right, home builders, right? You're looking to sell homes, you know, even if they rent the home, that's fine with you. You're just looking to sell that home initially. So a substitute product would be apartments, where they're offering the same good, essentially, right? You need a place to stay for your family, a place to cook, all that. They're offering essentially the same thing, but home builders, obviously, that's a substitute product, the apartments. Anything that's besides home building that fills that need. And so in this case, what you would want to look at is, and I'm going to stick with home builder example. What you want to look at is, what are the incentives of the customer base? You know, are they leaning more towards purchasing homes? Are they leaning more towards renting? You know, like for instance, in Texas, your cost of purchasing a home isn't too far off from renting, right? So like your monthly payment, once you encompass, you know, your principal, your interest, your taxes, and your insurance, right? So that's PITI. If you account for all those, it's not going to be that much higher than the amount it would cost you to rent. Versus with an apartment, you wouldn't see the same thing in California, right? So in California, their rent is a lot lower than the cost of purchasing a home. So there would be a higher demand for rent, for renting space, right? So you kind of want to look at it as, where are the incentives? Is this demand for your product? Is it sustainable again? It's kind of the same thing. Do you have any questions about the 5 forces? I mean, I know you're covering it.
No, I don't.
Okay.
Something you can certainly do, you got buyers and suppliers, and Bloomberg, I don't think they're used to SPLC.
Oh, no.
So it's really good. It shows the main suppliers and the main customers and how concentrated they are.
Oh, okay.
So yeah, SP is, I think it stands for supply or something.
Okay. Thank you. Yeah.
Supply chain analysis, but it's more on the supplier also.
Okay.
And then on the entry barriers, some of these companies are pretty international, especially on the metals. So, you know, be thinking about government, these governments are pretty corrupt.
Okay. Yeah. So how?
It has a whole new layer that you don't have with other companies.
Okay. So I'll check out that resource, and then maybe.
I can't remember what Cameron's company was. What was he doing?
Cameron?
American Eagle.
No. Oh, no. He's talking about for the sector.
Oh, for the sector. Oh, Vulcan Materials.
How do you spell
BULCAN.
that? Vulcan Energy? VUL.
So the ticker is VMC.
Yeah, there you go.
VNC.
Yes.
Victor VNC.
Colorado. Yes, sir. You said BNC, right, Cam?
VM as in Mary C.
M, sorry.
Oh, yeah.
Fix it. Jay, also, I see you're in here now. So Jay, I sent out the links in an email. to all of you. Xavier, I have to, I think I got your email down wrong, but I'll send that to you as well. So in the links, Jay, you know, Professor Sweet explains what he does in the model. So even if you can't come in, you'll see, you know, he's explaining why we're building that model. And so if you have any questions, you know, you can shoot me an email and I can address it in class.
It's interesting on Vulcan, it shows 60 suppliers, but they don't show any customers. I don't know what that means. They probably just don't, that doesn't, probably mean they're not customers. Yeah.
Yeah,
That's interesting.
okay, so that's basically Porter's five forces, right? The reason why I also covered it, I know in your senior year, you know, you'll cover this, but not everybody's in the same level. So we may not all, you know, see a firm or the industry in the same light. Okay, so that's the five forces. Did y'all, Cameron was telling me a little bit about Vulcan. Jay, have you seen anything on your firm? Oh, you put it in chat. Let's see. Haven't been watching. Okay. So yeah, if you see any news or have any questions based on what you see, then, you know, the reason why I'm covering Porter's five forces, right, is to give you that foundation, kind of how to think about the firm and also the industry. So Xavier, did you select the firm?
Not yet.
Not yet.
I didn't get around to it, but I'll be looking around.
Okay, no problem. Cameron, do you have any questions?
No, I don't. I'm just looking at the supplier and buyer power. I mean, I know the entrance. I mean, it's kind of hard to enter this industry because of the economies of scale type of situation and the, you know, that kind of stuff.
Cameron, Vulcan, just looking who they are, it seems like this infrastructure bill would be a big boom to them.
I couldn't hear. What did he say?
They construct roads and
He's talking about the infrastructure bill, that it would be like a big boost to them.
Yeah, I was reading that, and it was in the credit rating on the Fitch deal. They're talking about that.
yeah.
Thank you. Okay,
Well,
well,
that's passed, something will pass, and if you're building roads, boy, it seems like it's
I thought they said no, or they're leaving.
okay, well, so guys, we went through that pretty quickly. Y'all didn't have any questions. So I'm going to just pull up my laptop. I'll send this out through email after class. This link at the bottom is if you have any more questions or how you would look at Porter's five forces, you can go to this site. Strategic CFO, they do a pretty good job of explaining the five factors. Just give me one second. Okay, so to kind of just build off of Porter five forces, so this is from a report that I actually did with Victory, right? So this is a practical application again. So what we're going to want to do with the material sector when we're recommending a company, we kind of want to come up with a uniform way of looking at the firm within the industry, right? So it's kind of our own credit rating model. And I think that that'll give a lot of, it'll give us more credibility, you know, when we're talking to the analyst. It'll support why, you know, we think this is whatever firm we're talking about is a buy or is a sell. And this is building off of whether we think it's cheap or expensive, right? As we talked about last week. So the way that I kind of looked at it when I was at Victory was you give, I'm going to send out a link to what I'm talking about right now, but you look at their revenues, right? Okay, within the industry, where do they rank as far as revenue? Then also, you know, like the business profile, you know, their management, is their management more, are they better at managing, you know, the resources? So we'll look at the return on capital invested, right? We can look at things like that. And then we'll give them certain ratings for the revenues for, you know, their business profile. We can look at, you know, what's their leverage ratio. So debt is always very important. It's almost up there with revenues, right? And then we got to figure out what other key performance measures we're going to use to analyze them, right? And so I think we all need to pitch in. I'll probably come out with something more basic for next week, and then we can all kind of pitch in. We can say, you know, we think revenues, the goal is to give a percent rating to each thing. As far as credit ratings go, I don't know if you guys understand how those are created. You would rank, you know, the different like revenues, you would rank the leverage ratios. So we're going to try to do that same thing. And I'll send you guys out just a little bit about that after the class, as well as the 4 to 5 forces. Do you guys kind of understand what I'm saying, Cameron? Cameron? Oh, I think Jay logged up. Okay.
Yes, I was listening to you.
Okay.
I kind of lost the Zoom meeting link here.
Yeah. But do you kind of understand what we're going towards? Or?
Yeah, you were talking about the ratios and the debt and all that.
Yeah.
Stuff.
So we kind of want to build our own credit rating, right? To give them. Do we kind of believe, you know, the standard credit ratings where they're at? Do we think that they're, you know, maybe more valuable than, or they're headed in a better direction? Do we think they're heading in the worst direction? So we'll kind of look at that going forward, and then we'll apply the model that we already created. We'll apply 4 to 5 forces, and that'll be pretty much the underlying reasons for why we think they're rated what we give them. So we can come up with our own kind of system, and that should help us out. Xavier, do you kind of understand? Or I know you're looking for two. Okay, no problem. So we're going to come up with a kind of a credit rating of our own, and instead of just using the industry's credit rating, we'll try to come up with our own rating and see, you know, it should be pretty close to where the industry is, right? We don't want to be too far off, but that way we can, again, back up whether we think that a firm is cheap or expensive, right? If it's worth buying. So that's ultimately the end goal. Okay. So I think that's pretty much going to be it for today. Cameron, you know, next time, if you keep, reading some news and you find anything interesting, you can either shoot me an email, we can talk about it in class, or if you have any questions, just shoot me the email and then I'll include that in the next class.
Okay, cool. Sounds good.
All right, well, thank you for coming in.
Thanks, Nick.
Oh,
Yeah, 1 divided, open parentheses, 1 plus the rate. So you always have to do 1 plus, and then it raises that to the power. Yeah, sorry, boy, I was 8% was, I don't know. I was even thinking 8. I was probably thinking 8 years. All right, so did you get 1134 doing that? The discounted factor or the, yeah, so 1 divided by then 2 parentheses. 1 plus 0.04, close 1 parentheses, then raise it to the 1 or the 2 or the 3 or the 4. Yeah, to the power of times. So the power of 1, 2, you're just gonna use the 1 and then we'll copy it down. So it should be getting smaller and smaller as you go further out. Does that work? All right, and then you just multiply across the 60. So what is $60 that you get a year from now? If you use a 4% discount rate, what is it worth today? It's worth $57.69, then 55. It's smaller. Were you able to get the 1134 doing that? You just add them up. Yeah, that was the equal sum. Perfect. Got it. That's a really good skill to have. So I don't know what they're going to do in your finance class. I require my class to do it like this because I want them to see what a bond is actually doing. They may have you do it in your calculator. They may have, and we haven't learned how to do it on a calculator yet. We're gonna have to go back and do the exam on a calculator at the very end. But you can see in Excel, there's 2 ways to do in Excel. You build it exactly like this, or you do the MPV function, or there's probably a bond pricing function in a financial calculator. I just don't use financial calculators. I couldn't find anything in Excel that does a bond. So, we could actually look and see value a bond in Excel. Let's see what comes up, just out of curiosity. Bond valuation example. Let's just see what they give us. So C5 divided by C8 times C4. That's the cash flow, right? So what they're doing is C6 divided by C8, which is the it's paid twice a year. See this here, they're assuming it's paid twice a year. The example we have in the exam is only once a year. So they're taking the discount rate's 8%, but you're actually using 4%. And then C7 times C8, that it's 3 years, but since it's paid twice a year, it's really 6 periods. So that's the period. So it's minus PV, comma C5 over C8 times C4. That's the cash flow. C5 is the coupon, 7%, but it's paid twice a year. So it's going to be 3.5%. So that's $35. And then C4 is the face value. So let's try that. Yeah, so equal minus PV, O parentheses. In our case, it's 0.04, comma, and then we have 8 years, comma, and the payment for us is $60. That's the coupon.
$60 for the coupon?
Yeah, but times, and then they say times. No, we don't have, no, it's the coupon, it's the $60, comma, the $1,000. And it works, so there's, that works as well. Wow, interesting. Okay, I'll have to remember that. I think we've done that before, but I'm just not used to using that function. Yeah, so in that present value, you have to put every single cash flow in the present value. It says, hey, you're discounting at 4% for 8 periods for $60, and then at the very end, you get $1,000. And so it understands that. Now, what happens if this thing does like a normal bond and it doesn't pay every 6 months? Then you would use 2, 16, and 30, all right? You'll get a slightly higher number because you're getting the compounding on the $30. And that's the more realistic, and that's the way it was set up on this website, because that makes more sense. Almost all treasuries, all corporates pay twice a year.
So, what are you, and how do you get to the every 6 months instead?
I don't know why that's the tradition. It's just the way it's always been. But you do get a little extra interest because you get your $30 6 months earlier. You get to earn interest on that, and they just assume you make the same 4% on that $30 as everything else. So you'll get, yeah, not much higher, right? It's only oops, I hit something wrong. It's only 0.1% higher, so it doesn't add that much. But that's the more normal. So as you're learning this on the exam, the annual is just really unusual. They're only asking that question to make sure you know how to value a bond, but in reality, you would use this next. All right, so we learned a new Excel function. That's good. All right, now we're going to back in this a little bit differently. Is we're asking if you have a bond that's $1,000 and pays 5% annually, matures in 6 years, and you pay $941, what does that yield? All right, so now the obvious way to do this is that PV function, equal minus PV. So here we don't have the rate, but let's just try 0.045, comma, and how many periods do we have? 6. What's our cash flow? 50. Our future value is 1,000. All right. Do you recognize all of those numbers? The 4.5%. The 4.5% is answer A. The 50 is the 5% times 1,000. So that's our coupon. So your cash flow is always going to be your coupon times your face, unless it's twice a year, and then you take half of that.
Okay.
And then the thousands, how much the maturity value is. Does that give you 941.36? No. And what we know is, remember, if the bond is less than 1,000, the discount rate has to be higher than the coupon. So we know the 4.5 is wrong. All right.
So the coupon is less than 1,000?
No, if the coupon, so you have a coupon and a discount rate. If they're the same, the bond we price at $1,000. If the coupon's higher than the discount rate, then the bond's gonna be worth more than $1,000. Because you have this bond that's paying you 5% in a market where you're only getting 3, you're gonna have to pay more for that bond, because that's really good. You're getting 5 and the market's only giving you 3. If the coupon's lower, the coupon's 4 and the market's 6, then you'll pay less than 1,000. Here, the coupon is 5, so we know, because this bond is less than $1,000, we know the discount rate has to be higher than 5%. All right, so 4.5 didn't work, so let's try 5.6. Getting closer, but it's not 5.6. That gives me 970. Let's try 620. And there it is, 941.36. Do you see that? Yeah, perfect. All right, so that equal and minus, I'm learning stuff here myself. So I don't use these Excel functions. So minus PV, put the rate in, comma, not how many years, but how many payments. All right, so if it's annual, then it's 6. If it were semi-annual, it'd be 12. Then the coupon, not the annual coupon, but the actual coupon every 6 months. Here it's annual, so it's $50, but if it had been every 6 months, it would have been 25, and then always 1,000 at the end. All right, so there's probably another way to figure this out. But there's only 4 answers, so it wouldn't take you that long. And you know you can kick out A, because you know it's going to be higher than the coupon. So
in a situation where I don't have, whatever is not have time to play with, figure that out.
Well, here's how you could do it if you had to figure it out. All right, so we want to answer 941.36. So let's just key in a number. Let's just key in 5%. So here, instead of putting the interest rate, I'm actually going to reference that 5%. Let me put it up here. I'm going to reference that 5%. So instead of 6.2, I'm going to go right to the 5%. And that gave me the wrong answer. So what can I do? You can do data, what if analysis, goal seek. And we want that cell to equal what? 941.36 by changing our interest rate. And so that's the other way you can do it. Goal seek will find it for you. There probably is a way. Let's see if there's a YTM function. No. Let's try the yield function. There probably is. I've just got where I need to learn my yield. Settlement. Mature settlement is 1,000. Maturity is 6. Yeah, that's not it. So yeah, I don't know. We'll have to figure that out. My whole career, I've always done everything shorthand, I mean longhand, because I want to know exactly what the calculations are. But there is some advantages doing that. But you can see how that goal seek, I don't know if you've used goal seek before, but that will work. That would definitely work. And since they say you can use Excel on the exam, you know, you'll have it there available to you. All right, so you saw everything I did there. I just plugged in a number, and then I'll let goal seek tell me what the right number was, and then it gave me the answer. All right. Okay, let's try this next one. All right, so this one, so just put this in your notes. Anytime you see the word yield, it's income divided by current price. That's what yield means. Yeah, whatever your annual income divided by the current price. So these problems are really simple because your income is $3.60 and your current price is 120. So what's your yield? It's just 3.6 divided by 120. This is a really, really easy question. Oh, wait, I did something wrong. 3 point. I think I just typed the wrong number here. I think that's supposed to be 3%. Sorry. Did you get 3%? Yeah. Okay. Sorry. I just typed the wrong number. Yeah, that's just a typo. I'm typing these in. There was no check. So yeah, 3%. So you can do that with common stocks or preferred stocks. And it's the exact same thing. If it's preferred stock, they'll just give you an income and you divide it by the price and you got your yield. So yield is simple. Preferred stock is really not stock. Really, preferred stock is more like a bond, but it's kind of a strange animal. You won't see it much. They were real popular in the 80s because they gave you huge tax advantages, but the IRS changed the tax rules, so you don't see preferred stocks very often anymore. Well, what a preferred stock is, it's essentially senior to common stock. And a preferred stock looks a lot like a bond because it pays a fixed amount every single year. And if it doesn't pay it, a lot of them will accrue. So like with the common stock, they don't have to pay you dividends. They don't pay you dividends, you don't get anything. Preferred stocks, it's actually contractual. They're going to pay you a dividend. And some of them are accrual bond stocks. So that means if they can't pay you 1 year, they got to pay you double the next year. And so Well, if they never pay you, they gotta, it's like a bond. So you have senior debt, you have junior debt, you have preferred stocks, and you have common stock. So you have to pay your senior bondholders no matter what. If you got money left over, you pay your junior debt holders. If you got money left over, you got to pay your preferred stockholders, and then anything left over goes to the common stockholders. So the reason they did this is kind of interesting. The IRS gives a special dividends received deduction on stocks. And so what someone came with the idea and said, hey, let's borrow money, but let's not call it bonds. Let's call it stock. Let's call it preferred stock. So they did preferred stock so they could get that special IRS treatment. And the IRS says, okay, we got your game. You don't get the dividends received deduction for preferred stock. So people issued a lot of preferred stock as a way to save money on interest. And then the IRS said, no, you can't do that. So preferred stocks, if you actually went to like Victory Capital, they have stock investors and they have bond investors. The preferred stock would be on the bond side. Bond people buy preferred stocks, common stock people don't buy preferred stocks. So think of it as it's like a bond, but it's classified like stocks in accounting. So it's a weird thing, yeah. But anytime you see that word yield, those questions are usually the easiest. You just divide the small number by the big number and you got it. So yeah, it's a real straightforward thing. Okay, before we do the stocks, let's give you a really important formula here that you'll see this a lot. So if you have a stock that pays a dividend, say of $2 a year, and you think it's going to grow at 4%, what is that worth? So this, and then you have to be real careful here. Is this dividend 1 or is it dividend 0? All right. So when you see these questions, you got to know, is it dividend 1? Dividend 1 means it hasn't been paid yet. It's going to be paid next year. Dividend 0 means it was paid the last 12 months. Okay. So whichever of those it is, it's going to influence what you're going to do. I'm going to do this. You don't need to follow this, but I'm going to show you. Let's just say we're going to go out into the future. So how many more years will Walmart be in business? We don't know, right? So let's just assume it's several thousand. All right. I don't know how far down I can go here, but we'll go down several thousand or a couple thousand years. And so if this was dividend 1, then that's the dividend they're going to pay next year. If it were dividend 0, you would actually have to take that $2 and multiply it by 1 plus 0.04 to be $2.08. All right. So whether you're going to use $2 or 2.08 depends on what they give you. So if that's dividend 1, you use $2. If it's dividend 0, you'll use 2.08. All right. I'm going to use 2.08. And then what's the next year's dividend? Well, it's going to be 2.08 times 1 plus the 4%. And then we can just copy that down all the way down to the end. It's just growing. And by the very end, it's a massive number. In 1,700 years, it's 82 with I don't know how many zeros after it. All right. So the question is, what's the present value of that? And so let's say our discount rate, is 8%. So what do we do? You remember our discount factor did for the bond? We did 1 divided by 2 parentheses, 1 plus our discount rate, raised to the time, right? You remember that? So we'll do that all the way down. And then we'll get the discounted cash flow, just multiply across. Now you don't need to do this. I'm going to show you a shorthand of this, but I just want to show you how it works. So what's the value of this? You just sum up these discounted cash flows and you get a value of $52. But there's a trick in finance. It's called the perpetual growth annuity. And what it says is the present value of a cash flow that grows at a constant rate, it equals the cash flow 1, the cash flow next year, divided by your discount rate minus your growth rate. All right, so that's one formula you might get. The cash flow one, what they're gonna pay next year, divided by your discount rate. So what would that be here? Our discount, I mean, our dividend one is 2.08, right? So let's do that. 2.08 divided by 0.08 minus 0.04. Do you see where I got all those numbers? Yeah, the discount rate minus the, yeah. So guess what I get when I hit enter? I get $52. The exact same thing. So do you want to do all of this? That's a lot of work, right? What if they don't give you dividend zero? What if they give you dividend, I mean, don't give you dividend one, what if they give you dividend zero? What if they give you the $2? Yeah, so what you have to do here is you're gonna do CF cash flow zero times 1 plus the growth divided by the discount rate minus the growth. So it depends on what they give. You got to be real careful in the exam. What do they give you? So let's say they don't give you the 2.08. Let's say they give you the $2, but they say it's dividend zero. It's last year's, but it's going to grow at 4%. Then what you're going to do is you're going to do 2 times 1 plus 0.04 divided by 0.08 minus 0.04. And guess what you're going to get? The same $52. All right. So this has another name for it. Nicholas could tell you what this is called, but a guy named Gordon, and I don't know how to spell Gordon, O-N. It's called the Gordon Growth Model. It's also known as the dividend discount model. And I don't know why Gordon got credit for this, because I mean, it's something we've known for thousands of years. So this one here? Yeah, so if they give you dividend zero, if they say it's a dividend was paid last year, you got to take that dividend, multiply it by 1 plus the growth rate, and then divide by 8% minus 4%. If they tell you it's the dividend expected for next year, you don't have to make that adjustment. You just take that number and divide it. That makes sense. Now let's look at this question. Let's see if you can figure this question out then. How much would you pay for a share of common stock that will pay $6.20 dividend next year? So is that dividend zero or is it dividend one? Dividend one. So we don't have to make any adjustment, right? The firm is expected to grow at its dividends at 5%, and the required return is 9%. What is the required return? That's your discount rate. There's a lot of terms for that. Required return, cost of equity, cost of capital. I mean, there's a lot of terms. So can you do that one? What would be the formula here? So 6.2, do we need to multiply by 1 plus G? Not here, because that's dividend next year, negative 1, divided by, what did we divide by? 0.09. The 5% growth, right? When you do that, you get $155. You'll get at least one of those questions like Gordon growth or dividend discount models. That's what we do in finance. All right, so letter C would be the answer there. All right. All right, so why don't we stop there? But what we're going to do after this one is do returns. So I got to show you, I'll show a quick formula and you can try this, okay? So when you're doing returns, so if you want to try this, and we'll look at it next week, to do a return, the most common formula that you're going to use is the ending market value minus the beginning market value plus something on income. And then you're going to divide that by the beginning market value. All right, so you might look at that problem and see if that makes sense. I won't give you the answer today, but if you want to look at it and try it. So 1 year ago, you bought a share of Walmart for $144.15. Does that sound like an ending market value or beginning market value? Beginning market value. And sold it today for 150.06. So what is that number? Ending market value, and received a dividend of 219. What does that sound like? That's your income. So it's a pretty simple formula, right? You just plug those numbers in. Now, they said as a year ago. What if it was 2 years ago or 3 years ago? So they're probably not going to do that on an exam, but what we like to do is annualize numbers. And so you'll see in a future problem where we annualize numbers, like we want it on a yearly basis. So if they bought that stock 5 years ago, we'll get a return, but that return is going to be for 5 years. And we don't think in it's, hey, I made $27 over 5 years. They say, well, how much is that a year? Well, it's 6.2% a year. Say, oh, 6.2, that sounds good. But this is what we called, this is called a holding period. Oops, let me spell it right. This is called a holding period return. It could be for a month, for a year, for a week. The most common holding period return is for a month. We usually do things monthly. But on the exam, they tend to do everything on a yearly basis. You saw that with the bonds too, right? Everything. So what they're doing is they give you this exam between your sophomore and junior year. So the exam's a little bit watered down and simplified. So their holding period is exactly a year, where in real life we usually do monthly. The bonds pay once a year where they normally pay twice. So just realize when you take an exam, they've got a little bit watered down. But see that problem, see if you can get the answer, and then next week we'll work that one. And then next week we're also going to do returns, which I think is really cool. Of once you get the holding period return, what do you do with it? So let's say you've got 36 months of holding period returns. How do you figure out the average of that? What else can you do with it? There's a lot you can do. We do a lot of that in finance. So having 1 month return doesn't help us much, but having 36 months, we can take averages, we can take risk, we can figure out standard deviations, we can do betas. There's all kinds of stuff we can do with it, which is pretty powerful. All right, so we'll start there next week. Do you have the spreadsheet?
Yeah.
Okay.
I've been trying to keep it updated as we go along.
All right, so here we're down to the property, plant, and equipment. We have net. We'll have to see if we need both net and gross. The challenge when we're getting to the cash flow statement is that the gross, the change in the gross is going to go through cash for investing, and the depreciation, the change in depreciation is going to go to add it back to the cash from operations. So I'm tempted to actually do it gross and net. So I haven't quite thought through that yet, but we'll see. We may have to come back and change that. But at least let's take the net as a percentage of total assets. I don't know where our total assets is. So, oh, we're waiting to the end to do that. All right, so we'll bring that. We'll come back to that. Then long-term investments, goodwill, loans. You see, well, let's go back and look at their balance sheet and let's see what we really actually need to do. So long-term investments, it looks like we need that. Looks like we need goodwill, but fortunately, it's not a huge number for them. Yeah, that's the one, goodwill.
Isn't goodwill somewhat of an uncommon account for most?
Yeah, it's huge for us, yeah, especially for tech companies. It's anyone that's doing a lot of acquisitions is going to have a huge goodwill. So
Okay.
Hewlett Packard's probably the most famous one, where they made some really bad purchases and they had to actually write off. The goodwill has the exact same accounting rules and that lower cost of market. If you acquire another firm and it's obviously it's not worth what you pay for it, you have to write goodwill down. So it can have some pretty huge accounting impacts.
My accounting professor made it to be like brushed over goodwill, and it's like, no one ever does it. You have to be dumb to do that.
Oh no, that's pretty common. Yeah. Now with Costco, they're not big acquirers. I'm not really sure what these two goodwills are. It's just really bizarre. And so I'm tempted on goodwill, loans receivable, and deferred to just combine those with the other. Now we did see this huge jump here, right? And we're not really sure what that is. So that's part of a challenge. Why did that other long-term asset certainly jump up? So maybe I think I should have gone and researched that. But I'm tempted to do all of the rest of these as just other. So we're just gonna do other long-term assets. I'm gonna do equal sum, and we're doing which column? Column J. So equal sum. I used to be I, but it's J because I added this. So it's 36 through 40. So J 36, 40. Got 236 in that first year, and copy it over. And then I'm just gonna bring total assets up here. So we're gonna do this as a percentage of assets as well. So our other long-term assets, percent of assets, and total assets. So let's see if we can get our total assets to match. So we got other long-term assets, our net property, plant, and equipment, other current assets, inventory, receivables, cash, and then I'm gonna go pull the total from the balance sheet. Total assets line 41. Let's see if we get the same answer. We left, no, that looks good. Let's see if we get all the same stuff here. Six, 1, 3, 4, 2, 5. 6, 1. Okay, so we match. All right, have you gotten down that far then? So we need total assets so we can get our percentage of total assets for these last few accounts. Right, so our other current assets, you can do that divided by our total assets. So we can see what that is. Hopefully it's a small number. We'll copy that across. We're using 2% in our forecast. And again, I'm gonna graph it like I always do. Yeah, that seems reasonable. It's kind of bumpy, but 2% seems pretty reasonable. Our net property, plant, and equipment as percentage of assets. This is one that can be a concern. But we'll see over time what that looks like. It's certainly been declining the last few years. No, it bounces around a little bit there. Let's try, I mean, I'm always gonna, let's try 48. No, let's try 46. Let's just see what that looks like if we do that. Well, it looks great like that. We change the axis. Let's go 40 to 70. Yeah, I mean, it's definitely has been coming down. I think this last dip is because of that one asset that just showed up all of a sudden. And so we may have to look at that, but it's been in this range, you know, so maybe we ignore that. That seems unreasonable. 48 seems to be a good center part. So I'm using 46. So maybe we try 48 and see. I can get rid of this thing. Now you might say, well, if they're adding 25 stores a year, shouldn't it be growing? But they have several hundred stores, so the depreciation on that, you think about it, they depreciate over 40 years, that's about 20 stores, right? So the depreciation of the existing, that's kind of the advantage of their adding not adding a percentage of stores and not growing the stores at 10%, but they're adding a flat 25. So over time, the depreciation catches up. And so that may be why we can get around with using the net PP&E, but we'll see. All right, and then the last one is other long terms. We're going to do the same thing here. Take that as a percentage, and this is where we're going to really see that last year. See how much it jumps. Yeah, it really does jump a bunch, and without knowing what that is, that's why we have to do some research. I think I'm going to use 4% and just split the difference there. You know, it looks like it very varied, but we're talking 4 versus 6 on something like this. It's probably not that important because this isn't something central to their business. So we really just, on some of these accounts, it's like, I just need a number. And so I'm fine there. So I'm going to use 4 there. All right, so we're going to try my model. All right, so I don't know if you remember what it is, but what we want is the dollars that we do know. So we know, oh, I got to do cash here. We know receivables, we know inventory. We're going to divide that by 1 minus the ones we don't know. So I can't do this, and we put cash in there. So let's look at cash. How did I forget cash? So cash as a percentage of assets. This one can really be volatile, but an average number is perfectly fine, something like this. Look at this over time. 20% looks pretty reasonable there. So let's try 20% on that one. All right, so our total assets should equal receivables plus inventory divided by 1 minus the 20% minus the 8.6 minus the 2. Oh, not the 8.6, excuse me. Plus, sorry, I messed that up. So receivables plus inventory divided by 1 minus 20% minus 2% minus 48% minus 4%. Okay, Bill Gates, what did I do wrong? I don't see it. Okay. There's definitely something wrong with my formulas. So let's see what I did wrong. I did times. How did I do times? That's probably what Bill Gates was complaining about. All right, so I've got that in there. Obviously, I'm going to graph this one. I want to make sure I don't have something wild going on. Does that look reasonable to you for total assets? That seems pretty reasonable, doesn't it? You still got the COVID bump. Are you getting something like that, Colin?
What was it, 59,961?
Yeah, that sounds about right. 59,961, yeah. I love this approach. I don't know if anyone else uses it out there, but I think it works. And so we can check it just by bringing this formula over and make sure the two match, and they don't. So what are we? Oh, because we haven't. Oh, we have to put the numbers in, right? All right. So now we're going to put our numbers in. So our cash is going to be. We obviously can't use that function. We have to use the one we just built, right? Times our 20%. And I'm actually going to lock this in on line 27, so I can just copy it over. Copy it down. So there's our cash. I can copy that across. I should be able to copy that down to my current assets. Uh-oh, I'd be wrong. Oh, I locked in the wrong one, didn't I? the 45. All right. So there's my cash, there's my current assets, that looks reasonable. My net property, plant, and equipment, that looks reasonable. Other long-term assets, that looks reasonable. And it looks like they add up. 596. Yeah, so it adds up. There's got to be someone else out there who uses this approach, but I haven't found them yet. At USAA, it was plug it to other, and other got to be such a ridiculous number. And I don't think we have any ridiculous numbers anywhere in our forecast, do we? Cash looks pretty reasonable. Compare, if you graph each one of these, I don't think any of them are going to look strange. That looks reasonable. Already done receivables. Other, you always want to check other to make sure there's nothing strange. That looks perfectly reasonable. Net property, plant, equipment. This is a pretty critical one. Yeah, that looks perfectly fine. And that's one, the net property, plant, equipment, you really would expect a COVID bump, because it's not like they built 20 new stores because of COVID. That one should just be a straight line up. That one's volatile, but we're expecting that. And we still don't know what this one thing is. So until we figure that out, that was the one I think I said I was going to look at the quarterly numbers and see if it pulled back. So that's, I need to do a little more research on that one. So I'll highlight that in yellow that we need to do that. But so we got the assets. I mean, that's a really powerful approach. I would recommend keep that little trick and see if it might be useful at some time. It's so simple. And you might say, well, but we only have $14 billion in assets, but I mean, the logic makes perfect sense. It still works really well. I'm sure there's some companies that wouldn't work because they're just so volatile. All right, so we've got that. So now let's go to the liabilities. I'm going to do the same thing here we did before. So I added this column just to look. So accounts payable is really large. So that's one we need to look at. I'm probably, okay, well, let's see. Yeah, we're going to do these as separate ones. This is where we're going to do, remember last time I did the correlation? I think a better way to do correlation, it's really bad to do correlations on numbers that are growing over time because you always get a high correlation. What I should have done is take the change in every year and do the correlation of the change. So we'll try that here. That would give you more numbers. So that one makes sense. Current portion, long-term debt, that's just debt. So we'll have that there. Leases, looks like leases is a big number, but where is it a big number? So leases are coming in. I don't know what they lease, and that's a really volatile number. So that one we'll have to figure out. Oh no, it's the long-term debt. I'm sorry. Okay, that was one line up. All right, leases. Looks like that we can stick in other. So we want that one. We want that one. Obviously, short term, we want those two. Leases, I'm going to put that in other. Current taxes, I'm going to put that in other. Unearned revenue, obviously, that's a huge one. We were talking last time, that could be the gift cards. That one, obviously, we can put that in other. Other current liabilities. Yeah, that's a big number. So that's one where we'll do the correlation to try to figure out what income statement item it's most tied to. Obviously, we're going to have debt. Bring this down here. So leases, current portion. I don't know what. I'm tempted to combine the current and long-term lease into one number, just so we don't have to worry about the current leases. We're not going to count, when we talk about net working capital requirement, leases are not going to go under that. Leases are really a form of debt. I'm tempted to just have debt and leases as one line as well. So that could be, something to look at. But this one, deferred tax liability, I'm tempted to do that as other. So we'll see. It's not that big of a number, and other, well, we'll do other, the line. And then at the end, we're just gonna do common equity. We don't need these pieces are pretty useless. So, all right, so the ones we know we need, we'll just go get them. Oops, my forecast stuff. So accounts payable, we want that one. We want. All right. Oh, oh, wow, good. All right, so here's what I want to do the first time through this, and we may change our mind. I'm going to take all of the borrowings and all the leases, whether they're short-term or long-term, I'm just going to put them in one line that says debt and leases in one line. All right, we'll see. It may not work out, but we'll do that. Okay. So that one I'm going to move. So we'll just combine that, because there's really, you know, the accountants use that current ratio, but we never use that ratio, so we don't care what's current and not. All we care about is a net working capital requirement, which is accounts payable and accrued. We don't. The debt is the debt. We, you know, unless they're just abusing short-term debt, we really don't care about that. So we're going to combine this. What do we decide on current taxes? Current income tax, we're going to put that in with other. So we'll put that in other. Under revenue, we're going to use deferred tax current. I think we said we're going to do that. Oh, that's one we can combine with deferred tax. Again, we don't care about current versus long-term, so we'll just combine those. And then other, we'll definitely do that with long-term debt. We're going to combine. So that's all one big line. So we'll combine there. And then that last one will have our own. All right, so we know what we're going to do. So, you know, it's going to change company by company. It really depends on how material the lines are. There are some companies you would just throw unearned revenue in with other. But for them, it's a big number, so we're going to keep it there. So let's go get accounts payable. Column J. We can copy that down 2 lines. Here, the ones we're not combining, I'm going to go ahead and bring them in under revenue, current liabilities. We'll bring those in so we have them. Copy those across. I guess they didn't do gift cards back then. I'm going to go back and look at that one on revenue, make sure that's actually a 0. It's an actual, I'm going to change that to a 0 because it messes up my formula there. All right, so here down on line 59, I'm just going to put total debt leases. I hate the cap lock. Word I can't type. It's because my hands are so cold. Debt and leases. So let's go find those. What lines are they? Balance sheet. So it's lines 46, 47, 48, 46, 47, 48, 55, 56. Can you remember all of that? 6, 7, 8, 5, 6. 6, 7, 8, 5, 6. 6, 7, 8, 5, 6. Did that get it?
Oh, yeah, that's it's not.
Oh, okay. Boy, those are a real My word, I don't know. Boy, all right. There's a number in there somewhere. All right, so I have to get rid of these guys somehow.
Should we do like control, find, replace?
We could, yeah, that would, if we can, what is, it's the actual, that's a good idea. So let's see if it would work. They'll tell me, we might have changed some of the titles somewhere, but that's a good idea. Yeah, that works really well. All right. Did that work? Combined debt. All right. Did you get 941?
I'm still.
Finding them all. Yeah, I did 46, 47. Oh, why does it say 49? Isn't it 46, 47, 48? 6, 47, 48, 5, and 6. So I missed it by a line. So it's 48, 46, 47, 48, 55, 56. Okay. So we don't need that one, don't need that one, don't need that one. You know, what I'm going to do is I'm just going to have tax liabilities. The reason I have that is I don't consider income tax payable to be a working capital item, even though it's part of current. Deferred taxes I definitely don't include, but you know, to me, working capital is inventories, receivables, things related to the business. Taxes has nothing to do. So I'm just going to combine all the tax liabilities into one.
Okay.
Let's see if we can find where those are. And the real key, you know, is it important to your decision making? And if an account's just not that critical, even if it's volatile, it's like, you know, it doesn't really matter what this account is. Sometimes it's 1%, sometimes it's 2%, but who cares? We're just combining in there. So we have 49, 51, 57. Can you remember that? 917. All right, let's see if I can remember. 917. 9. 51, 7. I get 61. What time do we go to here? 1, 2:30, 3:15, 4. All right, we got a little bit of time here. All right, I get 61, but we'll see. All right, so deferred tax liabilities, that's done. Current tax, that's, so there's all our tax liabilities.
So can you go back to the, what we had selected for each section? So highlight it. Okay.
So payables, that we want, we got all the debt.
That's one of the.
Oh, there's,
I'm still way back there.
there's one of the dashes that replaced. It's like,
Oh, yeah.
there's probably a couple of
wondering why that
those.
was there. Oh.
No, that was perfect. It helps a lot. All right. So 46, 47, 48, 49, we've all taken 51. We've taken, so we just got 50. When we got 50 already taken, I think we already did 52 too, didn't we? Or did I forget to do that one? No, we need to do 52. I think we can just copy it down, right? No, let's see.
So long-term debt and long-term leases are both going into total debt and leases, right?
Yeah, it's like 5 lines, I think.
Okay.
46, 47, 48, 55, 56. All right, other non-current liabilities, I'm gonna go get that one. $125. No, wait, I already got that one. Oh, that's other non, okay, sorry, I went the wrong line. That should copy down though, right? So let's go see other non-current liabilities. It's line 58. Yeah, okay, so line 58. Line 58, yeah, right. So that one we can copy across. That should be everything. I did it right. All right, so let's do total liabilities. And then we can delete the lines we don't need. Let's go compare it to what's actually there. Liabilities. That looks right. That looks pretty good. That over 371, 684, 371. All right, let's go good. We got all the liabilities. I don't know if you're getting a number like that. Look at maybe 1999. You should have
I mean, I'm still on the total debt of these ones. I got 930, but I might have probably left a section out of that.
So you should have 46, 47, 48, 55, and 56.
40.
If you're off by one, that's
Oh, I think I forgot 46. I got 48, 49. 50,
you shouldn't have 49.
Shouldn't have 51 or 49.
Yeah, it's 46, 47, 48, 55, 56. You might have looked up when I was doing the tax liability. You picked up.
Yeah, okay, now I have 940.
All right. All right, I'm going to eliminate the lines we're not using. Just delete those lines. We might need lines added here in a second. We'll see. We don't even need total current liabilities. I'll take that out.
Yeah, accounts payable for expenses, unearned revenue, or the current liability. I know.
No, current liabilities and non-current liabilities are both in there.
Tax liabilities and non-current liabilities.
We do need other current liabilities because I am going to consider those to be a working capital.
Okay.
So I do want that one. It's a fairly decent, sizable number. Yeah. And unearned revenue, I'm going to take the word current off of there because that doesn't really tell us anything. All right, so I'm going to have to change my formula, and instead of summing, I'm going to add them because we're going to need to add some rows. And I don't want all that summed together, so do that. All right, so here's what I'm going to, on each one of these, here's what I'm going to talk about. So let's take the change in accounts payable. We're going to delete this after a little bit.
Okay.
And then I'm going to change in cost of goods sold, and I'm going to do a change in op expenses. Yeah, I just want to figure out. So some of this is scratch space. So cost of goods sold is right there. And then other operating expenses. Well, that's really it, right? It's just that SG&A. So it really change in SG&A. So we'll delete this a little bit, but so I'm going to copy these over. And then what I want to do is just do a correlation. So equal correl of accounts payable to I'm thinking cost of goods sold is going to be the one, but we'll see. That's a 0.69. See how much lower it is when you do it against the amounts, you get really high. So like if I do equal choral of accounts payable, oops, oh, come on, Bill Gates. That to cost of goods sold, I'm guessing I can get a really, really high number. Yeah, 0.99. So it's not when you do the change, and that's, I've seen that. I've seen students do that where they'll do a correlation like between the S&P 500 and small cap, but they don't do the percentage change. They do it to the top total. If you do it to total, you get like a 0.99 because markets just go up. Yeah.
Yeah.
All right. So that's not necessarily a bad number. So now let's do that to SG&A. So yeah, as we thought, it's higher the accounts payable. So we're going to do that. So we had all the scratch paper, but we've got it. I'm going to leave these in here because I want to do this again with other. So what we need to do here is just do this as percentage of cost of goods sold. So accounts payable as percentage of cost of goods sold. Where are you? Right there. And we hopefully will get a fairly constant number across with the 0.69 correlation. It may not be real stable, but it's jumped up some here. But I don't know a business reason for that. It's 9.5. The average is 8.6. I can't think of a reason. Why don't we go with 9 and we'll just have to look at it and see if that works. So we'll try 9. So there we can go ahead and forecast that one. We just take 9% times cost of goods sold. And then we'll graph it. It's going to be lower than last year because last year was a peak. The question is, how much does it stick out? So you're getting my tricks of the trade. Some of them may be exasperating, but this whole idea of graph as you go, make sure it's reasonable as you go. So that, maybe there's something COVID going on there. I don't think my boss would look at that and say, wow, that's a really crazy forecast. That seems reasonable to me. We know 2020 was an unusual year. I can't think of a reason why their accounts payable would suddenly be a much higher percentage. Maybe COVID somehow, I don't know how it would disrupt paying your vendors, but that seems reasonable to me. If we do the 9.5, I think it's not going to look as reasonable because it's going to jump up and then it's going to stay up. And I think if you do that, I think that might be a little bit more bizarre looking. I don't know. So you kind of have this, you have a bunch of noise, and then you're at a new high level. So there's a little disconnect between that and that. I like the 9%. It seems more reasonable to me. All right, so let's go try accrued expenses. So I'm going to add a column row here. We'll delete some of these rows here in a little bit. So I'm going to try the change in accrued expenses. I'm hoping this is going to have a high correlation to SG&A and not the cost of goods sold, but we'll see. So equal choral of this to cost of goods sold is 0.63 versus SG&A 63, 63, 63, 50. I was wrong. All right. It's more highly correlated to cost of goods sold. I can't explain why that would be the case. You would definitely expect, did I do it right? That's SG&A. Yeah, that looks right. 55. I do it versus 51. All right, we're gonna do it. Percentage of cost of goods sold. I mean, I'm gonna go with the math. I do like to think about if I can come with an answer. Maybe this will be the last one. Well, let's do we'll do the revenue, under revenue, and then we'll be done there. All right, so we're gonna do that, percentage of cost of goods sold. It's not a big number, so maybe it won't matter all that much. All right, so it has averaged right at 3%. It's been much higher. I'm gonna go with 3.5 on this one. It looks a lot more reasonable. That's probably not one that's kind of a, it's gonna come through our working capital, but I don't think 3 versus 3.5 is gonna have a huge impact on our working capital. And so we can go ahead and forecast that one. Accrued expenses times cost of goods sold, and we'll look at it over time and see. Yeah, that looks reasonable to me. All right, so we got that one. So let's do one more on revenue. I'm gonna put spaces. All right, so I'm not even going to question it. I'm gonna say percentage of revenues, but we'll look at it and see how consistent it is. We know the first year is 0 for some reason. Maybe they didn't do gift cards back then, but that across. I'm going to do the average without that 0 in there. It's definitely growing over time, but it averages right around 1%. Man, 1%'s perfect number there. No reason to do anything more than that. So 1% works perfectly. So we can do that one. 1% times revenue. Quick graph. Yeah, that looks pretty reasonable. Again, you got the COVID effect, but and you have some other effect back here. That looks reasonable. All right, so we're in good shape. All right, so we'll definitely next week we'll finish up the balance sheet, and then the fun part, which is building. I actually really enjoy doing the cash flow statement. It's a good practice of organization and understanding things. All right, so we got a few here to still go. We've got to do other current liabilities. That we're going to do the same way. We're going to look at it, a percentage of those. That one we're going to do a debt to equities, so that won't be too much. Tax liability, we might do that as percentage of taxes. These two will do exactly the same as the others. We'll look at it in a correlation to those other items, and then we'll have it, and then these two, this will be debt to equity, and that won't be percentage of. So it's possible on the tax liabilities there won't be a good relationship to taxes, but we'll just have to see. And then we don't need these other lines. We just need total common equities. So we'll see on minority interest. Hopefully it's a small number. Let's look down there. I'm hoping it's a really small number. It's about 150. It's getting up into 500. All right, that's one. I'll probably just do a fixed number across, all the way across. If we can find some way to come up with it, but I don't know I have no idea what that is. What does that even mean for a Costco? I know like for energy companies, that's a massive number for them, but for Costco, but it's a small number. Well, it's somebody owns you, that's not a stockholder. So it's, some ownership. I don't know, maybe it's a founder or some family member or someone. Now with energy companies, they have these what do you call them? Oh man, master partnership, whatever. And those are massive, and they do that. In fact, Cornerstone did one, Corner Store did one, and the guy came in to see if I probably shouldn't have this tape. he was explaining logic, and I thought his math was wrong. He's trying to show that it was a benefit to the stockholders and to the minority interests. And when he showed his numbers, they're like, you just stole from the stockholders and you gave it to these minority interests, because that was a bad deal. But he had one major, I can't remember what it was. But I'm hoping this, we're looking at this as percentage. What is that number? Total assets. Yeah. It's not even 1%. So I'll probably just put 525 across and not be worried about it. So, all right, we're good. Man, I'm getting there. And it seems tedious to me. It's kind of fun. It seems tedious, but you probably get this entire thing done in a morning.
Yeah.
Right? We've taken 4 so far, so that's 3 or 4 hours. So you can within a couple of 2 or 3 days, you could have one of these built. I think the downside is the way we're building it. Once you get this built for Costco, you can't necessarily just bring another company and use the same format, because we're changing things. But I think every company has different lines that are important.
Now, like, investment banking analysts that do this for a living, how detailed do they get in terms of like, I don't know, like modeling volatility of whatever account, or like, I know investment bankers aren't like mathematicians, but do they get into that at all, or do they just kind of do it like what level of detail?
I think we're going lower detail than they do. A lot of them won't build a balance sheet at all.
Yeah.
Or even the cash flow statements. So a lot of them, they just have a few items like the revenue, net cost, gross margin, net margin, and beyond that, there may be some key balance sheet items they'll build. I like to build the whole thing because I want to make sure it all ties. So that's kind of the old accounting to me. And it gets back to me with USAA is, if the account they're plugging to is off, it's just a massive number, then obviously there's something else wrong in the forecast. And just say, well, that's a plug figure, $100 million. It's never been more than $2 million historically. It's like, well, that means you get on $98 million. If you never do this whole thing, you never know that. So if you're building everything like that, you say, and so where is that error? So this, to me, I just like to do this, but most people don't, because if you build it in the detail, there's always something that looks wrong and you got to deal with it. And but I want to deal with those things. These firms are complicated. To eliminate the complication by just going so high level. Yeah, doesn't to me.
PowerPoint's a bit weird now. Okay. Welcome to Resisting Censorship with Blockchain Tech Class 4. And if you guys were here last week, you guys know it's kind of a mess. Yeah, I wasn't able to get my PowerPoint open, and I had to do everything by links. I don't want to do that again. This time I prepared pretty well. You guys are going to hopefully like this. And here's a disclaimer, and the boxes are kind of in a way. Okay, all the information shown in this class is not intended to provide personal attacks nor financial advice. This information presented is intended to be consumed and used for educational purposes only. I am not an investment advisor, nor am I a tax advisor. I'm still a college student myself. Please consider your own personal circumstances and speak with professional advisors. Independently research any data and information you may rely on, whether for making an investment or tax decision or otherwise. Be smart about this, guys. Don't just don't do what a lot of people in the crypto world are doing, just going all in one coin and hopefully trying to make it to the moon. It's not a good investment strategy. It works sometimes, but a lot of the times it's pretty bad. Blockchain terminology. I normally try to go through this pretty quickly every class, but I hope you guys know what blockchain is. It includes Bitcoin, Ethereum, Dogecoin, Litecoin, Monero. Roughly, they're tokens. They enable the common man to realistically a tech-savvy or internet dweller, mostly used in crypto now, to be able to go without intermediaries such as a bank. And a blockchain utilizes a public ledger comprised of various wallet addresses. You can easily one of the advantages of Bitcoin is that you can easily search up addresses and see what's happening there. Like it's a huge public bookkeeping thing. And this peer-to-peer style of transactions via individual wallet address characterizes most of the cryptocurrency transactions today. However, that's kind of a flaw there. NFT question, non-fungible token. Basically, it's a piece of media attached to a blockchain and it has the public, which is tied to an owner. I kind of talked a bit about this last two classes, but for now I want to talk about a different subject. That is Bitcoin. What is the flaw of Bitcoin in terms of privacy? Anyways, the transparency, Bitcoin itself always prides itself on that. It's one of the reasons it got so popular in the first place. You're able to, it's almost like a trustless system, but as they like to call it in a white paper. However, it is a double-edged sword, as mentioned. It's not entirely private. The blockchain, as I said before, is very public. I have to emphasize that. It is very, very public. You'd be surprised how easy it is to just find transactions. We can easily find whale addresses, and that itself is a flaw in terms of privacy. You view by internet. Bitcoin is not anonymous. It gives details about transactions between addresses. You can connect the details to someone's real life identity or someone. You guys are familiar with skip tracing, right? Or bounty hunting. They tend to do that a lot. You can easily do that in the blockchain too. As you can see in the comic right here. If the coins existed in real life, it'd be like a person just announcing everything they do. And it's good as a token and for accounting purposes, but do it every time, it's kind of annoying. Privacy doesn't matter. Yes, it does. You want privacy. All right, move on around this scam thing. It gets interferes. I want to show you this video. This guy explains it better than I do. His channel is called 99 Bitcoins. And I took a clip from it to better explain privacy and why we would want it. It's very weird. Like, we have to explain to people why privacy is needed. It's a very strange time we're living. Good point. Oops. Anyways, difference between privacy and anonymity. People tend to use this anonymously. It's hard to, I even used this anonymously a while ago, but you gotta know a difference. Privacy, You don't want others to know what you're doing. If you're going to the bathroom, you don't want everyone to know exactly what you're doing. It's always a bad idea. Anonymity, which is actions are public, but your identity is concealed. I think we all, to a certain extent, want anonymity in our day-to-day lives. We want to do public actions, but we don't want to announce it to the world. It's always a bad idea if you want to do that. Let's see. Private person anonymous. 99 Bitcoin guy explains it very well too. Yeah, exactly what I said. Enter Monero. I have to remind everyone, the translations are a bit awkward because I took clips from the YouTube video. If you guys want to follow him, his channel is 99 Bitcoins. I'll put his channel on a citation page. And remember, I'm always sending the PowerPoint after class. Oof. Camera. Anyways, I should explain more what exactly Monero is, or as a symbol calls it, XMR. It's basically an open source and so-called privacy-based cryptocurrency that launched in 2014, a little after Bitcoin did. It's created to be opaque by disguising the addresses used by the participants, details like identities of the senders, recipients, transaction amounts, and other transaction details become anonymous. And it does this through the usage of stealth addresses and ring signals with help with privacy. And if you look at the image right here, if you guys are there IRL, it's kind of hard to see if you're in the chair. Feel free to go a bit close if you want to see it. Anyways, a normal, for example, Bitcoin, you have the private key and a public key to get an ordinary signature like this. The problem with that is you're very traceable. However, if you do the Monero way, which gives you multiple stealth keys or distraction keys and other, as it does right here in the image, you can easily disguise your identity as you're doing this. And that's one of the strengths of Monero. Another very good strength of Monero compared to Bitcoin is that you can easily mine it. You can mine with anything with crypto, but for Monero, you can do it without special hardware. You can do it with your own CPU. You don't need to buy any fancy graphic cards. If you guys remember the graphic card thing, people weren't able to buy it because the price got so high of people using it for crypto mining. I think the price kind of stabilized now, but it's hard to come. It's still a bit more expensive than it was before. And the Monero itself means coin Esperanto. I think the creators of Monero wanted to send a message with that, make it more international, just like the language of Esperanto tried to be. It claims to be a safer network where participants can face little risk of being refused or blacklisted by others. Yeah, unfortunately, in a crypto world, it's still a bit full of drama. You don't want to get involved in all that. And here's a better image that compares Monero and Bitcoin. As you can see right here, or if you guys are there in a lab, as I said, feel free to go a bit closer. You might not be able to see it. Yeah, I'm looking at the webcam right now, and it's a bit hard to see, but yeah, Monero beats Bitcoin on privacy, fungibility, and transaction fees, and also mining algorithms too. As you can see right here, Monero, the transaction fees is only around 2 cents, while in Bitcoin it's 39 cents. And Ethereum, yikes, I don't want to talk about Ethereum. It's wow. You can make NFTs with Ethereum and other cool stuff with it, but the transaction fees is always a pain with Ethereum. And scalability, yeah, Bitcoin beats us on that. What Bitcoin beats Monero is on transaction speed, scalability, widespread adaptation. Everyone knows about Bitcoin now. It used to be kind of an underground thing, but now it's mainstream. Even when everyone's referencing it, even comedy shows. It's bizarre. It's kind of bizarre to see that. I'll give an anecdote about it. When if you guys remember when Dogecoin went up, my parents were really talking about it. It's a very bizarre sight. It's like the older generation are now getting aware of crypto too, and it's good in a way, but also it has this. It's pretty bad. If it goes mainstream, you lose a lot of the underground advantages. Kind of like what Bitcoin was. And not to mention the return on investment since creation. Yeah, that's this is a bit old, but since Bitcoin was created, it increased over 24,000%. As compared to Monero, it's only 17,000%. Even so, it's insane. Years ago, this would have been unheard of, having an asset class with such crazy returns like that. It's the reason we're studying it. The reason I got interested in it's why we're crazy about it. It's feasible. Not just digital money here. It's important stuff. But as you can see here, there are pros and cons with it. But if you want to have my opinion, I made a little slide about it. The future of Monero is an interesting subject. It very is. However, I wish to discuss Monero itself as a proof of concept. I'm using this term a lot throughout the class. For maintaining fungibility and privacy and anonymity in a blockchain. There is a possibility, I don't want this to happen, nobody does, that Monero and Bitcoin may not survive the conditions of the future. God, I would be so sad that happens. But we have to be resilient. If we understand them both as a proof of concept, we can use the technology of the blockchain to be able to better protect our privacy and anonymity. Things don't last forever. Even the most durable stuff don't last forever. Even steel rusts, the earth changes, the rivers changes, the mountains get eroded. The same thing applies to a blockchain. A token which may have been strong right now, it might not be so strong in the future. Think of all the past forms of currencies that we use in history. The franc and other stuff, it always changes. I think this applies to the blockchain too. Always remember that. You got to be resilient, guys. You have to not go put all your eggs in one basket. Things might die. And things might live too. Which is why, even in a blockchain itself, something might arise in the future and we have to be there to take advantage of it. That's our duties as an investors, is to better cultivate and to basically make money off of it too, but to mostly cultivate the technology too. That's our responsibility. Don't just look for the next Bitcoin, as marketing people like to call it. Just look for the best technology possible. Cultivate it. Here's citations. And as I said before, I got this from the channel, 99 Bitcoin, which basically describes a lot more about what exactly Monero is and from a beginner's perspective. And I like to use Investopedia too. That's a very good website too. And Exodus, I have no idea, but the blog was good. That's it for the presentation right now, but I still have a couple of things I want to share a bit. Okay. Hey, you guys have any questions? Feel free to unmute yourself. Nothing?
I got a question for you.
Oh, sure.
So you can mine Monero with a CPU?
Yeah, it's theoretically any normal CPU.
And then you can transfer it to your wallet, and then you can transfer it to Ethereum or Bitcoin?
Yeah, you can easily transition it to other cryptocurrencies, but I think if you do that, you lose the advantages of the privacy of what Monero.
Right. I understand that, but I'm looking for a way to mine without having to buy a video card. So if I have a few PCs, laptops running around, then it makes sense to maybe if you have, cheap electricity, you can do it.
I see. I think that's definitely an advantage of Monero is that you can mine it anywhere. I remember there's a product that claimed to be able to mine crypto from your smartphone, but that isn't very practical, honestly. Smartphones aren't exactly that strong, despite all their advantages. No cooling, definitely. Any more questions, guys? Yeah, I want to share this one thing if you guys have any questions. It explains a bit more about how Bitcoin transparency is worse than we think. As the article mentions right here, you can be tracked. The companies are doing it right now. This was 3 years ago. Not a new thing, guys. As the guy in the 99 Bitcoin channel mentions, Bitcoin is pseudo-anonymous. It's when you first get in it, nobody knows who you are, but over time, you can easily be tracked. That's the thing about Bitcoin. You can allow people to link wallets to the real world identity. You can send stuff from your personal wallet to an exchange wallet, but over time, you can be tracked. The companies are doing. Apparently a company called Chain is doing it too. It's as mentioned in my first class, criminals always jump on stuff like this. It's if you can find a way to make use of modern technology to help criminals, and they adopt it on a widespread basis, it's a good technology, but again, criminals are using it. Money laundering, exactly. If you guys remember on the dark web, there was the Silk Road. Yeah, easy just instead of just going online, you just buy illegal stuff online. Crazy. And a lot of this stuff is on California too. The Silicon Valley. I don't want to give too much my opinion, but kind of be careful. Those people from California, the Silicon Valley companies, they always they see data as a new gold rush, where whatever we just share, what we do. Yeah, it's what the original creator of Silk Road got busted for it. What tragic what happened to him. You guys have any comments or questions? Any more? As I mentioned, Zcash Monero is not the only privacy coin in the market so far. There is a Zcash too, but unfortunately, I don't know. I've only covered so much about Monero. I'll likely try to cover other privacy coins in the future too, but there's still a whole heaps of other stuff to cover. Oh yeah, I forgot to mention this about Monero, but it's a very important thing about it. There's a new innovation called Ring CT. As you take a look right here, You guys can see my highlight. It allows you to, it's basically kind of an update to Monero. When you send a transaction to Monero, 600 random signature, the full of a blockchain or transaction, anyone viewing it would be unable to figure out the signature belongs to the sender. There's a transaction, but nobody knows who's going, what's going how. Unfortunately, as it's not, I don't think it's available on Monero right now. It would be a cool concept to apply, but it's not, it's not there. Kind of like Lightning and Bitcoin, if you guys remember that. It's supposed to make the transaction faster and cheaper, but so far, not a lot of people are using it. Oh yeah, I want to share this one too. I want to. This is hilarious. Here, yeah. Sorry for the pauses, guys. It's just I want to show you guys this. Why hackers use Bitcoin? Why it's so difficult to trace? Seriously? That's the problem with the mainstream media.
How old is this article?
Yeah.
How old is this article?
2020. Wow. That's insane. It's crazy. I should explain this a bit more. It's kind of the mainstream financial world. They weren't expecting cryptocurrencies to pop up, and it just ambushed them. And analysts and everyone else was struggling to understand it, and you get stuff like this. They try to understand quickly, but they just what they understand gets quickly outdated, or they just didn't do their research. Increasingly used in scams. Beginning maybe, but no. Yeah. Oh yeah. Remember this one? Remember that huge Bitcoin scam on Twitter? If you guys were on there, basically hackers pretending to be. They took President Obama's, Bill Gates, Kanye West, and other famous accounts, and they just run a big. They hacked their account and they run a big. They made a post about about them wanting to give everyone a reward. Just send me Bitcoin and I'll send you more back. It's a classic cryptocurrency scam.
Wasn't that an inside job? Wasn't there like an employee within Twitter that was somehow got the access to these high profile accounts and was making money off of them?
I'm not sure if it was inside, but I do remember seeing it there, me personally. It would make sense. I mean, if it's just an employee, you can easily do that. You gotta vet who you hire in these kind of tech companies. There might be a hacker, might just waiting his time to take advantage of the environment. Unfortunately, the scam was shut down eventually. Yeah, Twitter is a mess, honestly. Not sure if you guys have mentioned this before, but I got banned from Twitter. They never gave me a solid reason. They have these political purges they always do. It's kind of annoying. Yeah, as mentioned before, everyone was confused about what exactly cryptocurrency is. What the heck, Bitcoin? What is that? Digital money? Ha ha ha. Yeah, that's always their initial reaction, and then eventually they get surprised by actual value as a blockchain technology. Why did the hackers ask for Bitcoin in the first place? Yeah, freeze your Bitcoin like the credit bank address. A Bitcoin wallet is something you can possess and control without going through a third party. Bitcoin is a choice for scammers because of that. As I mentioned before, it's super traceable. Yeah, they tend to forget about that. It's the reason why the scam was shut down in the first place. Is Bitcoin traceable? Let's see. Everything is see what you do now, but they can assist your identity. The transaction history as a fingerprint. It can exclusively identify you. It can be connected to you. Connected Bitcoin transactions to malicious actors become a valuable tool in law enforcement for the exact reason. Why the heck they say it's untraceable in the article, in the heading? They admit it's traceable, but why it's so difficult to trace, yet they freaking easily do it. It's just funny things about that. I fell for the clickbait. Can we track the thieves? Yes, they can. Why did you say it was hard to do so? And chain analysis, the company that was mentioned earlier, they can easily do that. Bitcoin is traceable. That's the big deal. It's complex. Yeah, but it's traceable. Anyways, thank you guys for joining my class. Again, sorry for last class, the third class. It was a bit of a mess now, but thankfully I managed to get PowerPoint up pretty well and share a couple articles too. Thank you for joining my class. And if you guys have any comments or questions, feel free to ask them. And for now, I'm going to share the attendance sheet right now. So you guys can easily enter that into your attendance.
One-handed drop the link there. All right, so welcome to class, y'all. Today, we're going to be focusing in on one really important concept, which is going to be DeFi, decentralized finance. We're going to watch a 15-minute video on that pretty much explains from a fundamental perspective. Like, we're going to get into the nitty-gritty kind of technical stuff. So we're going to be excited about it. I'm going to pause during it so we can have some discussion about it. But I really think, you have Bitcoin, you have blockchain. DeFi is in this world of crypto that we are discussing. And DeFi, I believe, is going to have one of the larger impacts out of all these technologies. We were discussing before class, the concept of, what value these projects provide. And that's really what we're going to get into today is what is the value behind the decentralized finance. But before then, just so we can, stay consistent with what we do here, we're going to go and check Coin 360 out. I'll put it on here so they can see that there. So right now, if we are going by the day, we took a slight dip, but over the past 7 days, we've been kind of slowly just shedding off market cap from that recent 66 plus K Bitcoin pump that we had. Right now, which is super interesting, is Shiba Inu is just popping off right now. Like over the past, since October, it has 100x. If you bought in even with a couple, like $50, it adds up and you get the return. So it's cool to see this. If we go and compare it with CoinGecko, which is really surprising, is it actually has passed up Dogecoin in market cap. So if we look here, Dogecoin is at rank 11, and Shiba is at 9. So there was a flippening there. That's what's called is when you have two coins that are kind of rivals and one surpasses the other. It's a flippening. So that was cool to see. But anyways, let's jump into DeFi. This stuff is really important. And I think it's going to change the world. So let's just jump right into it. So one of the main sources I use to keep track of DeFi is going to be DeFiPulse.com. And if you just type DeFiPulse.com into Google, you'll be able to get that. And we've reached a milestone of $100 billion in value locked up into the DeFi system, which is a huge market cap. We want, I think that in the next 10 years, that is going to go from 100 billion to at least $1 trillion plus, because of just, I think it's the idea of, it goes back to the idea of centralized versus decentralized, being our own banks and functioning as our own banks rather than other banks profiting off like lending, for example. But yeah, we're going to jump right into the video here.
What is DeFi? Well, it stands for decentralized finance. In the past, we have always used centralized finance, which is where there's a central authority that controls the flow of money. The government and the banks control it. They don't really say they do, but they do. They can print more of it if they want to. They can stop you from borrowing it if they don't want you to. They can even stop you from having a bank account. If they wanted to, at any time, they could have your money. They have your money. So they could change it, and you really couldn't argue against it. I mean, you could, but how would you prove it? You gave your money to them. It was based on trust. Also, if you're running a business, they limit what you can do. For example, right now, if you have a little magical tree business that may be for medicinal purposes, they can tell you not to bring in any of that money from the business to the bank, which seriously limits you. It means you can't deposit it or invest it or even use them to keep it safe. One more thing, traditional finance is quite expensive. Payday loans go up to 500%, credit cards can average 25%, and even personal loans can cost you 18% of your value. These are really high rates, but you pay them if you need to, because that's what you...
The TV.
Whoa.
The alternative is decentralized finance, where there are no banks. Instead, there are pieces of code that run and act as a bank.
Okay, so this is a really important concept to get, and it took me a while to really understand it, but this is the key. No more banks. We're using code as our banks instead. Contracts written in code. So it's a trustless system. So we don't have to trust in human error that might occur with the regular centralized financial system.
Bank. They're open to anyone. They don't require you to trust them because they're literally a piece of code running a program. If you wanted to, you could read through it and verify that it's not going to scam you. They are also censorship resistant. And lastly, they're much, much cheaper than traditional centralized finance. Decentralized finance is built on three main things: cryptography, the blockchain technology, and smart contracts. If you don't know what these are, we highly recommend that you check out our other videos on these topics, where we break these topics down so simply using stories and examples and analogies that even your grandfather could understand them. Now, this is going to be a bit...
I do recommend y'all go and separately research these three main topics here of cryptography, blockchain, and smart contracts, because that is kind of like the pillar.
Bit of a longer video, but it's a very broad and growing topic. Anyways, assuming you understand the cryptography, the blockchain, and how smart contracts work, let's dive into the 5 pillars of decentralized finance. Number 1, stablecoins. So first off, we need to understand the bridge of decentralized finance to centralized finance. And that is cryptocurrency that is matched to a real-world asset. For example, DAI, Tether, and USD coin are all what we call stable coins. This is because their price is tied to the United States dollar. Think about it like this. When you buy one for $1, a new USD coin is minted. When you withdraw one, a USD coin is burned. So the coin is always worth $1 United States dollar. Now the purpose of this is to have a reliable way to buy and sell certain coins without having to buy and sell them. Instead, we can just trade them. Here's an example of why this might be beneficial. Let's say you bought one Ethereum at $500. Well, now it's $1,000. And you want to sell because you think it's high. You want to take your profits. Without stable coins, you have to sell your Ethereum at a centralized exchange like Coinbase or Binance. And in return, they they will give you some United States dollars for it. Now, of course, they're going to take a cut of that transaction because they want a fee and they're going to take it. Also, the IRS makes you pay tax on any gains that you make from trading or selling. Coinbase and Gemini will be snitching that you made it, so you can't really get around it. The next step would be to wait for Coinbase or Binance to give them to your bank and then withdraw them from your bank because you don't really want the bank controlling your money. Well, a month later, Ethereum drops to $250 and you want to buy more, so you deposit your $1,000 back into Coinbase, wait a few days for the transaction to clear because you have to wait, and then buy 4 Ethereum and hold them. Well, Ethereum rises again to $500 and you decide to sell. So you sell them at your centralized exchange. You bite the fee and then you wait a few more days for it to hit your bank account. See, in this example, there's a lot of fees, there's taxes, and there's waiting. Now, let's say we utilized a stable coin like USDC. You bought 1 Ethereum at $500 and it raises to $1,000. Instead of going through all that headache, you trade your 1 Ethereum for 1,000 USDC and you just hold it. A month later, similar to the previous example, it drops to 250 and you trade your 1,000 USDC for 4 Ethereum. Then it raises to $500. And here's the beneficial part. Within 5 minutes, you sell your 4 Ethereum for $2,000. The fees were less than 1% because you used what we call a decentralized exchange to trade, which is something we'll explain later. But because of it, you were able to trade almost instantly. Plus, the USDC was secure and you trusted it because it's just code. It doesn't change. Unlike Coinbase or Binance or Gemini, which are controlled by the government and, more importantly, people.
So it's important to consider strategies that implement stable coins in your portfolio. So it would be beneficial to start thinking of maybe keeping like a 5 to 10% reserve of stable coin if you want to have some gunpowder per se. So if the market does take a big dip, which, you know, we love crypto when it's up, but remember what happened in 2017. Remember all the crashes previously. It can go down as quickly as it's going up. So hedge your bets, hold some stable.
Have been hacked before. Anyways, we are getting off topic. So that's the purpose of stablecoin. You can be in the crypto sphere without actually using your government-owned bank. Now, in a lot of places, we take banks for granted, like in the US, but some countries are really limiting in how much money you can move around or what currency you can buy them from. In fact, in the United States, every transaction over $10,000 has to be vetted and approved by a bank. Meanwhile, using a stablecoin like USDC, you can move $10 million from one address to another without anyone blinking an eye for like a $5 fee. You could never do that with United States dollars. Number 2, borrowing and lending. So another important pillar of decentralized finance is lending and borrowing. In fact, a huge part of our current financial situation in the world is based on lending and borrowing money. So it would make sense that the blockchain could do it better. One of the reasons we can reliably lend and borrow with banks is because we usually put something down like 20% collateral so that if we never pay back the full loan, our government can come after us and throw us in jail or make us pay that money. In short, there are legal consequences for not paying a loan back. Well, with crypto, this is a problem because one of the pros of crypto is anonymity. You can put 20% down and run away with the rest of the loan never being seen again. So we have to find a way to solve this. In fact, with the use of smart contracts, we can actually allow others to use our funds while still keeping custody of them. So let me go through a little example. Person A wants to earn interest on his coins, while person B wants to borrow some coins. So person A goes to Compound or Aave, which are 2 platforms that allow crypto borrowing and lending. And person A deposits his coins into a smart contract. If you don't know already, smart contracts are just code that run a particular function. In turn, what he gets are called C tokens or A tokens that are a representation of his original coin plus interest. Whatever he wants to, he can just turn his A tokens or C tokens into that smart contract that was created by Compound or Aave, and they spit out his original deposit plus interest. Now, the smart contract is created this way so that there's no human being that has to do the calculation or have to do the transaction. It's all automatic by code. So that solves person A wanting to earn interest by lending in a traditional way. In the borrowing portion, person B must do something called over-collateralize his loan. This means if he wants to borrow $100, he must put up $120. So that way, if he runs away and never pays back his loan, the smart contract is written in a way that it can pay back person A their coins plus interest. Now, at this point in time, you might be asking, what's the point of taking a loan if you already have the money? Well, you're probably thinking speaking in United States dollars. Say you have 10 Ethereum worth $1,000 because they're each worth $100, but you don't want to sell them because you greatly believe in the Ethereum project. So you put them up as collateral and borrow $800 worth of Tether, which is a stable coin pegged to the United States dollar. So you trade that $800 around, you make some money, you lose some money, you make some more money, and now it's time to pay back your loan. So you have $850 in Tether, and you pay back the original $800 loan to get back your 10 Ethereum. Well, in this little example, you made $50 from the little trades that you did, and you got lucky, but it has also been a few months. And Ethereum, like it has done in the past few months, exploded. And now they're worth $150 each. So now you have 10 Ethereum at $150 each. So now you control $1,500 plus the $50 you made trading. Basically, if you believe in Ethereum and you have it, but don't want to sell it, and you want to use the value of it, you can take a loan out on it, hoping that it will be worth more whenever you cash it out. However, if you traded, you lost some money, you gained some money, and then you lost some money, and maybe you ended up with $750 Tether, you would have two options. Option A is to front the extra $50 to pay back the full loan, the $800, to get back all of your collateral, and option B is to just keep your $750 and lose your 10 Ethereum, which could be worth a lot. Now, this might be information overload, but real quick, there is a second type of loan in crypto called a flash loan, which is a loan that lasts for like 10 seconds. If you could buy Ethereum for $10 on Coinbase and then sell it for $11 on Gemini, theoretically, you can make $1 every time you did that. And so you can use what we call is a flash loan to literally borrow millions of dollars. You don't have to put any money down. You just write a flash loan to borrow $10 million. You tell it to go buy Ethereum for $10 and then immediately sell it for $11. And then you pay back the original loan, $10 million, and all one small little smart contract that gets run in 10 seconds. Essentially, you made $1 million minus the fees that you had to pay for borrowing. But these fees are small because the lender knew that you would have to pay them back and that it was for a very short period of time. Now, this is a more advanced technique, but you could never perform this type of arbitrage in traditional finance. Number 3, decentralized exchanges. Okay, so I have a friend who traveled to London a few years ago.
Real quick, I wouldn't recommend trying to do any flash loans. That's like definitely like a higher level, like you're deep into crypto to try to do that. But I mean, if you're interested, I mean, like look up how like trying to get maybe like a really small loan for maybe a longer period of time.
From the United States. Now, of course, in London, the standard currency is euros, while over here in the US, it's dollars. So naturally, he had to visit a foreign exchange booth and trade out his dollars for euros. Unfortunately for him, the fee was like 15%. So he immediately lost 15% of his money because that's what foreign exchange traders do. Tourists don't know any better and they need local money. So what they do is they take advantage of these people. Well, when it comes to decentralized finance, instead of a foreign exchange trader, we have what is called a decentralized exchange where you can exchange your coins and tokens for other coins and tokens. Now, the fees are usually very small, like less than 0.5%, which is a great benefit for anyone who regularly wants to trade their crypto assets. Most popular decentralized exchanges, or DEXs, work in a manner where investors pool their money together and then traders can trade that money. The fee of every trade that I mentioned earlier goes back to those investors, and it's all written in code so it doesn't change. A government can't step in and say, you can't buy Bitcoin anymore. The fees and the percentages that you change are locked too. They're written in code, so they don't change and they can't raise to crazy prices like 15%. Decentralized exchanges open the world up to a whole new variety of tokens and coins. For example, Coinbase, the first centralized exchange to go public, only allows you to buy and sell 32 cryptocurrencies at the moment. Since they are regulated by the government and have to abide by certain regulations, they very closely analyze each coin before adding it. The most popular decentralized exchange, which is called Uniswap, literally has hundreds, maybe even thousands of tokens that you can trade, and they aren't regulated by anyone. That's the decentralized part. There are billions of dollars locked up in these liquidity pools so traders can trade, but nobody can control these billions of dollars. They're just following a program that someone wrote. In fact, only investors can be the ones to pull out their money out of the pool. But if they did that, the lending rates would rise, and so new investors would come along and put their money in. So like I said earlier, the code can't be changed either. It's what we call immutable. So in the crypto space, we like to say that the code is the law. The government doesn't control it, the code does. And everyone has access to the code and it doesn't change. Uniswap is one of the major exchanges on the Ethereum network and it has billions of dollars in its pools. PancakeSwap is another exchange on the Binance Smart Chain network that also has a few $1 billion of liquidity. Number 4, insurance. Insurance is really easy to explain. For example, with car insurance, you pay $100 a month to protect your new Tesla. However, one day while using the autopilot feature, another car causes the autopilot to glitch and you drive into a ditch. Unharmed though, but you totally wrecked the car. Well, since you paid insurance, the insurance company pays you what the Tesla was worth so that you can go buy a new one. They use statistics to predict how many of their drivers will crash their cars and then use this data to predict how much they would have to pay each year to determine what the monthly price of the insurance should be, which is also called a premium. Well, with decentralized finance, the insurance company can be code. So let's go over an example. Let's say a farmer wants to buy crop insurance. So if his crops die, he still has income for planting them and taking that risk. We could write a piece of code on the Ethereum network that says if there's any days this summer that are 90 degrees Fahrenheit or hotter, 4 days in a row, pay out Farmer Joe $100,000. However, to start this contract, he has to pay $2,000. So Farmer Joe can buy his crop insurance through what is called a smart contract, which is just code that sees if the conditions are met to pay him. So at this point in time, you might have two questions. How does the code know if it's 95 degrees Fahrenheit, and where does the $100,000 come from? Well, to connect the real world to the blockchain, we have to use something called oracles, which are trusted sources that become a bridge between the real world and the crypto world. We can create an oracle in our city that reads the temperature and is verified by a few people to make sure that it can't be frauded. Then the smart contract can reliably use it as a data source to decide if insurance requirements are met or not. Secondly, the $100,000 comes from other people buying insurance that bought the premiums, but maybe they didn't get paid out because the requirements were not met. Just like an insurance company makes profit, people who provide liquidity to any decentralized finance platform may be incentivized with an interest rate to earn on their deposit. In other words, some of the $100,000 may come from investors who earn money by lending their money. Lastly, we have number 5, which is margin trading. So margin trading is a whole new beast. Let me explain margin trading in the traditional world real quick, and then I'll explain it in the decentralized world. So you want to buy the Apple stock, and right now it is $100. So essentially what margin is it is a loan that will automatically sell your stock if the stock goes below your down payment. So to buy a $100 stock, you need a $100 loan. And the bank agrees to give you that $100 loan if you can give them a $20 down payment and a small fee of 5% a year. So here's two scenarios that could happen. The stock goes from $100 to $150. You have paper hands, so you decide to sell the stock and you get $150. You pay back $80 of your loan.
Never have paper hands, y'all. Make sure you have diamond hands.
The bank already had your original $20 as a down payment, and you keep the rest, which is a profit of $70. So essentially, you made $70 by only spending $20. This means that you more than tripled your money, even though the stock only went up 50%. This is the power of margin. You use it when you think something is going to increase in value to multiply your own money. Now, let's take a look at another situation. This is the second scenario, and it's if the stock drops to $50. Well, with margin, you actually have to sell as soon as the value of what you bought can't pay back your loan. So the stock starts out at $100, then it starts dropping, 90, 85. And then as soon as it hits 80, boom, the bank forces you to sell your one stock of Apple at $80 so that you can pay them back those $80 that you borrowed. So the $80 you made from selling the stock plus the $20 that you gave them as a down payment equalizes the loan. And now the bank has their original $100 they originally gave you. So you're free and clear, you've paid your loan back, but you didn't profit anything. In fact, you lost your original $20 that you put up as down payment. In centralized finance, to trade on margin, you usually need to be able to prove who you are, along with have a minimum of a few $1,000s to even have access to margin trading. The fees are also much higher than 5%. In decentralized finance, margin trading can be a lot quicker, open to anyone in the world with money, and a lot safer as well. So wrapping this video up, we have covered 5 big pillars in decentralized finance: stablecoins, lending and borrowing, decentralized exchanges, insurance, and margin.
Does anyone have any questions about these?
What is the difference between decentralized margins and decentralized margins? Like to be compared.
Yeah, I think where you're like the difference between borrowing on margin with a decentralized exchange versus a centralized exchange. Is that kind of what you're asking?
Yeah.
So yeah, with a centralized exchange, I would say the biggest difference from my perspective and perspective of most crypto people is like the anonymity factor of being able to stay anonymous when you're operating So another kind of concept to kind of consider is possible applications of this technology outside of the traditional crypto realm. And some of the possible applications that I think that we might start to see is going to be real estate mortgages. That's like the biggest one that comes to mind. And obviously we are so early talking about this that like the companies that are going to do this haven't even been created. And then you remember you had a question real quick?
Yes. All right, so what happens if we have like a flash crash and you have, I forget the term, but essentially where like you get margin called, but you have way lower, it happened too fast. Is this possible?
Yeah, you get liquidated. That's what happens. I mean, if the contract is executed and it has set terms where if it hits a certain price, you will be liquidated. You do get liquidated. And I know it from experience because I've been liquidated myself.
But like in crypto, like things happen much faster than even the stock market sometimes. Could it go faster than the smart exchanges?
Yeah, I mean, the speed is definitely super quick with crypto. And there are some instances in which people try to exploit the DeFi system to try to do like $1 trillion loan and sell it in like 2 seconds for like $1.3 trillion, right? And there's been hacks before with centralized crypto exchanges. Even the DAO got hacked, which is a decentralized autonomous organization. So, I mean, the system's not perfect yet. It's definitely not. And it's got a lot of room for improvement. And you're right, the speed is definitely a big factor in it as well.
The words I was looking for was liquidity crisis.
A liquidity crisis. Okay. Gotcha.
Do you see a future where like companies no longer go public in the traditional sense we know them and offer, say, like their token shares on the like a decentralized network like Ethereum, the Ethereum network, versus just putting them
through the traditional IPO,
through like the New York Stock Exchange or something like that? Especially if you're a completely decentralized company or whatever. Like if Uniswap was an actual company and they had actual shareholders, well, they kind of do it in a way, but like, you see what I'm saying? Yeah,
I see what you're saying. And I think you're bringing up a really great point, actually. And I think that that is going to happen in the future. And there are going to be companies that raise capital using decentralized exchanges and creating their own token for their company because the traditional IPO process might not be the best way for them.
Yeah. I think like the buzzword would be like democratizing like venture capital or like angel investing and all that.
That's a good word for it too. Yeah, that sums it up pretty well. And I mean, that's kind of the whole ethos of DeFi is accessible and transparent financial system. Because, you know, crypto was born out of the ashes of the 2008 financial crisis. And, you know, what we're trying to do is create a better financial system for future generations, essentially. What was your question, by the way?
You guys actually covered it.
Okay, sweet. So the other possible applications are going to be like small business loans and micro loans. I think this is going to be very important because it actually is going to provide that, as you were saying, you know, democratization of the financial system. And hopefully this can help, you know, people who typically wouldn't have had access to the system because of all the loopholes. I mean, and not loopholes, hurdles, and inefficiencies. You know, and a lot of the costs are unnecessary in the financial system, and where everyone's got to get their percent. And then the problem is right. And this might be an oversimplification, but like in the traditional financial system, you have like a stack of like 10 different, you know, layers in which every single layer, everyone's getting their percent, right? And with the decentralized system, you're kind of just going direct to consumer, like to the to the point where you are the bank, like you are your own monetary entity. And yeah, it's cool, man. I mean, we literally, the thought that you could be your own bank would blow people's minds 50 years ago when, we had multiple financial crises and people were running to banks, running on to banks was like a whole big deal during the Great Depression, bank runs. So now it's the opposite. We are like, they're not going to do it. We're going to do it our own way, and we're going to figure out our own system. But yeah, DeFi, look more into it. It's going to change the world. I'm telling y'all now. Check with me in like 5-10 years. I could be wrong. Could be right. But yeah, I mean, really look into it. Like, there's a lot of cool projects. Aave, Compound. For people on Zoom, catch y'all later.
All right. Everybody got our spreadsheet up here? The one that says, I believe, 76%. Yeah, 76% right here. So our goal is we're trying to get up in the 90s so that we can have a stronger model. And by doing that, we're going to continue to bring in some more ratios, some more medians of ratios over time, averages of ratios over time, and change in ratios over time.
Did you look for outliers?
I don't believe so.
I'll keep trying that. I can sometimes. So just highlight the 2 columns. Yeah, those 2 columns. Slide chart. Have a few things to chart. Got a couple outliers, although I don't know if that's kind of, yeah, I don't see the list. Two big outliers there. You can try, except you can find them. The key is if you can find them. If you don't want to delete them, you just want to take them out of AF and AG. Just delete them. So 7789, you can find that one. $289. No, so it's 89 in the AG column.
Sure, there's a faster way to do this.
There it is right there. All right, just delete that. We'll go look and see what company it is. So we can find Pepsi or somebody. Just go ahead and hit delete.
Land deck.
Never heard of it. Package food. Probably good stuff, but I've never heard of it. What I did you ask for that?
Yeah, 76.
All right. We have one other one there. There's a couple things you can do. You've got so much data here. Is there any obvious data for that 6791? I don't know which column is which, but see once. That might be a great company, right? You rank 4th in the market. 4 is where the market has it. Right? 67, is that right?
Here's 67.
It's actually a really good stock. It's one, the market ranks 67, so you rank 4th.
6781.
I got two. All right, so that is really expensive. Okay, that's one you wouldn't buy anyway.
22nd Century Group.
Yeah. Okay, so now delete those two. Then I can check the 72.
right, so, I mean, is there any data you wanted to bring in that you haven't brought in yet?
Maybe 5-year, average return on invested capital.
Okay, so bring those in, but the next thing you can do is something to think about. So as you bring them in, the one last thing you can do is bring in some subsectors and sort them by subsectors and just go subsector by subsector and delete those 2 columns and see what's for results. Trying to just figure out there's one subsector that's really messing everything else up. And that can be really powerful. So
Try that
I
now.
don't know if it, that's pretty simple to do because you delete them with the R squares, you put them back in. You have to rerun solver because the weights might change. And you already got your sectors in there, right? So you might use column D. You already have it sorted by those. Yeah, so you might try that.
Where you sort column D.
Or sort the whole thing by column D. I mean, sometimes there's one group that's more on the tech side, but one group really messes things up. He's got a real power score with that thing. It might work.
Can I just do it from here? Do I need to go to the part where I do all?
Just make sure it sorts everything.
We want to start with D.
Make sure you got the entire thing across. Okay, yeah, D, and you do have a header. Put that box if you have a header. Right. You may have to put a freeze frame so you can see it. Really is pretty simple. Seconds. You have the G, just highlight these 2 columns. Starting at row 4, highlight all the different details. Not always, too far, right? Column
Yep. Sweet.
Square. I made it worse, so control Z, that one. I'm just leaving the back. A little bit better, I just keep that in mind.
I think it made it worse because we were at 79 and it went down to 78.
It doesn't mean you're going to eliminate, it just means you run them as a separate model.
It's just so we can know what's doing what. 84 by deleting.
So maybe you do households as like a completely separate model. Now you got to rerun solver because you can get it higher than that. You're about 50% at least. You're getting there.
Should I go back and add these back in and then just look at which ones are hurting us the most?
Well, actually, what you can do is copy that entire sheet, make it a new sheet somewhere else on the next page.
the right, AG, copy, go down to the bottom, and copy those formulas, AG all the way down to the bottom. There's two companies you can do it. Probably at 7456 all the way down to the bottom. What? Roll up. Short, bottom of the column, right there, 7456, double click. I'll click on them again, 7476. Highlight them, go all the way up. Above that. All right, now I'll be going to solver. Yeah, those are really low. Yeah, you gotta be stable solver. You didn't copy the solver over, so how can you do that? We're gonna maximize that at 36 by changing those weights. So find those weights. And then you took the row 2, put that, and do that out of the way. Strings. So you can stick with that and say, okay, we've got more work to do in the household, because it's not working. Now here's one where the outliers can really help you. So go down to the bottom and look, and go look at your graph on the outliers. This is where you can look at Owens. No, it's not really that bad. That looks a lot better than 55 to me. All right, so what you can do is finish your model for the sectors that aren't households, and then you have to come back and do more work on this one. But you can keep adding, you still have them in there, so if you want to add more stuff and see if it still works, you got everything there. That's the advantage of not deleting the companies, but just deleting the ranks. And then everything's there, you just copy them in and out. You're up to an R squared of log off. 70% looks like almost.
How can you tell that?
Just square that 85.
All right. Should we try to do the 5-year return on invested capital?
Yeah, we want to add more of it.
I mean, not necessarily, but I think we should. Is that the piece that you would add next?
What all you have? Something on turnover, there's something on mark, 2 things on margin. So yeah, return on capital thing is good. There's something working capital, that's good. Yeah. You really can't do anything on risk. You don't want to look at the 5-year default every time. That doesn't make sense. You don't want to look at the debt. Things on risk, I like what are the current numbers, that's what I'm going to do. Something that's working over time. But return on capital, you guys don't have.
All right.
You already have it set up, right? So just copy and put the copy in.
Put it about here.
Well, no, the far right, remember? Far right, you know, from the first. And then you take AN to AR, copy that over. And same thing with the next, the entire column, copy over. AN to AR and just copy everything. Yeah, and I just have to change the title.
Should we go get
and just I think all I see. have to type it out. No, you don't want 5 years, you just bring it in, right? You're gonna have to 5 years. There it is right there. Yeah, you got it. And usually when I set things up, I do the first title and the AU, and then I have the rest of them as a reference. So every time I change the first one, so I have this like 5-column block. And so all I gotta do is copy that block over and just change the very first account and all the others automatically update. So AU3, we just do equal AU3. And then use that block again, and all you gotta do is change that very first one. Copy that over. Oh, no. No. Yeah, copy that over. All right, so now just go to the right and off to the left. Go back over to the left and figure out where you're gonna put it. Put it next somewhere next to return on capital. What do you have for return on capital?
Working capital.
Yes. There it is. And then you put it between P and T. Medians, right? Median ROIC. Median. The frustration with all of this, and like it.
AD.
Not delete the fundamental on 8.1. All right, so we run the solvers.
Do I need to change this to 0?
I don't know why that's 100. Yeah, I mean, that should be 0. I mean, just 100. All right, so try it and see. Y'all see what I'm saying? Didn't like it. So after all of that, didn't like it. But that's the thing, we have it set up now, so go back and change that ROIC and change that first account. I mean, watch how fast it is. So AW, go find return on equity and then add some things in. Bloomberg find bills. Yeah, I think all the others. See why I did that equals AW. And now we run solver and we're done.
Wow. Is it
We have
this,
a company that's probably carrying all of
that top? Yeah, right here.
All right. Well, it's going to be unanimous still. Deleting all. Can you go over to the left? Where you have the ranking. Go over to your where you had the return on invested capital. The meeting where you can find that one. So P on P. Probably it's not Q. Q4, let's try it, see if it works. Q4, very beginning of that, you get error. At the very end, comma, 100, comma, minus 100. Just to have some down in it, right? Few of them more as well. All right, now we're solved.
What does minus 100 do?
It's just, I didn't like that one either. But now you have that 5 set up, so it's just a matter of trying other things. I don't know what else you can do. You did EVA, right? You do kind of have a return on capital. Did you do EVA somewhere over here in the side?
Yeah, we did change an EVA.
Where did you do that? I don't see it in there. Working capital balance. Oh, oh, there it is, columns KLAN. Okay. What else can you do on capital?
Change in gross margin or change in EBITDA to revenue?
Well, you're doing the median gross margin, and you could try change if you wanted to.
I don't think that's going to help a whole lot.
Have you done the FTW in a while?
We did it last class.
Anything there on capital?
It was just the 5-year return on invested capital that we saw last time.
So there's nothing else. Like Bloomberg is shrunk, and the mouse is on it, so. But my eyesight's not very good. Staples. They don't really have a return on capital, so it's just under profit. Did you try operating margins? Sometimes Wall Street's far more focused on operating margins than anything else. Just try change that AW from return on capital. Just go find operating margin. I agree it's not radically different than EBITDA margin, but sometimes you get better results. I'm not sure it's a that's, you know. We're going to do that solver. Let's see. What I can do now is just try every single possible number there is. You want to, let's see, you have what, 15 minutes? Have you ever done a buy sell list before?
The only the one I saw you do last semester.
You want to try that real quick? And then,
yeah.
So add 3 columns contain AI and J. All right, so what we want to do is figure out which stocks we want. So AJ is going to type difference. So you probably want a positive number to be good and a negative back. Okay, so you rank, let's look at the first stock. AI is your ranking. You may want to put that in AI there if you know. So AI 3. You want that to be, just call it our rank, or fundamental rank, however you want to do it. Not our rank, our fundamental rank, however you want to say it. Okay, so what you want to do, if you want a positive number to be good, then what you're going to do is click on plus, go to the next row, plus AH4 minus AI4. That's a negative number. Why is it negative? Because you rank it, so put it in there. You rank it 56, that's the 27th most. The next one, you rank 85th and it's 105th most expensive. You can find a really great one. What's the biggest housing number you can find? $27. All right, so go to the very top. So we'll find it. We'll let Bill Gates find it for us. Go to like AJ1. No, go to AJ1. I'm going to show you. Let's just get our AK1. No, AJ1. So one is so there's two things we're looking for. This is what I want. I want a big difference, but I want a big number. Right. So AJ do difference. And the next one do call it quality. Go to the next line and call it quality. So in AK1, we want firms that are at least, let's just throw out one. Let's say 10. The difference is at least 10. Okay. How many companies do you have?
107.
So about 100. All right, let's say we want the difference between 10, we want them to be in the top 30. Top 30. Yes, we need one more column, but we'll do so. Just the first one, let's make it a virus. All right, so go over there and just say 3 and type go back to 8. Sorry, columns. That's a virus, so go to the next row. So equal AJ4 is greater than or equal to AK1. So if you click on AK1, $sign, comma, if disease. If comma there. If, let's see what happens all the time. If AJ4 is less than or equal to AK2, $sign, comma, 1, comma, 0, close parentheses, comma, 0. We see what I did there. So when am I going to get a 1? Comma, 0. You'll get a 1 if that number is both bigger than 10 and less than 30. Otherwise, you'll get a 0. So you have copy those down. Oh, you got way too many ones.
There's a bunch of zeros right here.
Go back up to the top. Let's just see. So, you don't see another row. Go back up to the top. There's some 23, so that seems a little high to me, but that's okay. You can check. Why don't you, can you add one more row at the very, very top? Why don't you just make one just do an equal sum and sum up all the lines? So change, let's just see how simple it is. So change the difference to 15 and see. So how many people? We got 15. So we have like 5 people. So you got to think about the spring. So in the spring, and plus you got that other group of households. How many can you handle with 5 people? Maybe each analyst can look at 2 companies. So maybe you can handle 10 companies. So maybe you're going to pull 6 from here and 4 from households. So you want to get this down to like 6. Make that top 25 maybe. 25. Now, who are they? Let's see if you like them. part of my concern in Staples is we get these education companies that don't like it all, and we also get the multi-level marketing companies. We really don't like. Credible life and those type. If your parents sell that, that's fine. You gotta be able to see A before you.
Yeah, why can't I get over to A? Oh, there's another, gotcha, here we go.
See, no, don't be beat. You won't see unless you know your tickers.
Oh.
Yeah, it's kind of, I'm also curious about the come in though. Yeah, I kind of want to see those.
How do I get, what did
If I
I?
were you, I would just go to AL. Just do AL, just do equal A1. Just an AL6, just do equal, not the, or either AL6, or AL5, equal A1. A5, excuse me, A5. Copy that down. No, at B5, excuse me. Copy that. Sorry. Yeah, we're not gonna buy a Rite Aid. They're going out of business, right? Have y'all ever been to Rite Aid? Been to Walgreens, been to CVS, but Rite Aid is the one that's gonna. No, it's up north. They still exist, but they're just getting crushed by Walgreens. Albertsons, I don't want to do Albertsons. Walmart's killing them. But you're maybe gonna find out that's what it is. Natural foods is actually a pretty interesting one. Spartan Nash, that might be a multi-level. So what you do is, so here's the other thing you do. I'll show you something really cool. Go up to AM4, the Bloomberg search, type description, type the company description. Spell description. There it is. Well, down, right there. Add that. And then right below that, AM5, the people, PDF, PDP, PDP, parentheses, A5, AM $4. Oh, there it is. Okay, so you just have to just read it. Click on the Rite Aid. No, go down to natural foods. Click on that and set your F9. Click on that one. F9. F9 working?
No.
Well, here's what you can do. Go click on AM. Control C. Right click and paste it as values. Right. Control Z. Are you trying to read the whole thing? Yeah, I want to read the whole thing. Can't you just click on? Yeah, right there. Yeah, but it's going to be so wide. That I just want to be able to see it in the cells. I'm sorry. I don't know why it's not letting you control paste the value. So Rite Aid Corporation operates a retail. I don't understand why they control C paste the values. Try AM again. Control C. This time when you right click, do paste special. Paste special. Click on the paste special. Values. That's so good. That's not gonna work. All right, so go down and you have an apple. Click on that one. Just hit the F2 button. Keep that in. distributes natural foods and related products. That sounds good in this environment, right? The company offers natural products consisting of groceries. So it sounds like they actually have stores, don't they? Have y'all been in the natural foods? I mean, someone find them on Google, look at their website, see what they look like. Nutritional supplements, I don't care for that. It's fine.
I think I've been to natural grocers. Is that different than national foods?
Now, if you go to Bloomberg and find the company, don't have any actually will link to their website. So they don't have stores, they actually. So they have wholesale.
I think they're like a brand new store. I mean, they have an online store, I'm not sure.
It says they're a wholesale. Okay, so you can see them in the store. Y'all recognize the brand? They have a button that says brand somewhere.
No, they're strange brands.
Yeah. And I didn't know.
Yeah.
Oh, yeah, they're a natural and organic food company.
Organic too. I'm not a big fan of organic because our farmers in Costa Rica, they tried organic. They can't make anything with organic. The extra cost is so much greater than the extra revenue because Americans want organic and they want to pay for it. Right, well, that's a keeper. That's an interesting firm. So go down to Spartan and Nash. The same one there. So retail facilities, retail customer company also what? It provides food wholesale. That sounds like the same company again. Also says the process gathered by gathering and food to vending workers. That's interesting. So you have 6 companies, but writing is not going to work. Kroger maybe, or it did at one point. Who's that? No, you're thinking Kroger. Kroger's the grocery store.
Yeah, I knew that, but
I
I
know it's. I know.
Okay.
It's
Wrong page.
You know what I'm talking about, right?
Yeah. I thought Kroger is closing soon. I don't know.
Yeah, I don't think so. I would rather Kroger's over Albertsons, but,
Does anybody know how I get rid of this frozen column over here to the right?
I don't know.
What are the other ones we have?
Some of the view, you just have to figure out how to undo whatever.
Oh, I had it split this way. Okay. All right.
So the 6 isn't enough because you're gonna kick out some of those, so you just keep changing your number until you get some more companies, right? And so you're just trying to.
Sounds good.
What else did you have? You had one more down below, right? Seaboard, I've never heard of Seaboard. Acquisition, transportation company, Port, which is a huge problem right now. Ships, cargo, I don't know what that is.
Yeah, it processes pork and ships cargo. That doesn't make sense.
Same thing after that, I don't know what that means. Company also merchandises commodities, milk, flour. Generates electric power overseas. Wow, this firm is like way too diversified. Pork is definitely a huge issue right now, right? What percentage of pigs have died because of
They process pork and they provide electric power overseas.
yeah, really they are.
And produce sugar.
Ocean transportation company?
Sugar makes, I don't see. Sugar's okay, that's definitely a. Merchandise is commodities, I don't know what that means, so yeah, that firm might be a little too.
And they're a shipping company as well.
Yeah, well, it says they ships cargo. Yeah, I mean, like, what else would you ship? We ship non-cargo. Anything that's not cargo, we ship. Right, you see the process, right, Ron? So at this point, you've got to figure out, so you don't want to do all of this until you finalize your model. If you're going to keep changing your model, don't be doing what we're doing here, but that just shows you the next process. So you've got what, 2 more weeks?
How do you guys feel about our model? We're at 85%. We wanted to get to the 90s. Do you think we should continue to add things in to get our model more accurate, or are we okay with our accuracy level? Should we continue to try to narrow down companies so that the team next semester can take that small list of companies and start doing an analysis on them? It's a tough call. I'm fine either way.
So, like I said,
What happened to make
yes, sir. It was just like a computing error. So I summed product and I included the market value. Yeah.
If you use EV skills and forecast EV skills.
Yes, sir.
No, but you still got a better model of how someone tax before. That's really good.
Thank you. Hopefully it was organic.
And you don't want 100% because it just means price right. So
yes, sir. Okay. Let's look at our chart here. I went ahead and built out tech, no semis, and then did the chart and pace values. If you want to go look at this on your own and you're not on a Bloomberg machine. I also ran it for the semiconductor industry. 78% correlation, 62 R-squared, not horrible. And did the chart for that as well. There's not as many companies.
You would think semiconductors would be higher, but the fabs and a lot of fabs are really.
Yes, sir. Yeah. It's interesting what it took and didn't take in terms of the fundamental metrics.
Yeah.
Most of the cash ratio. The cash ratio is the amount of times that we could pay your debt in cash.
Yeah. I'm surprised that's not high.
Yes, sir.
Especially
The default. Yeah. Is there, I don't know. We may need to find a metric to take most of that responsibility.
There's one thing on that that's always been effective on that. It's expected revenue growth or expected earnings growth. Works really well. The downside is whose forecast is it? We rely on other people's forecasts.
Yes, sir. I don't know if we should try that. It's kind of.
Well, you might try a DVA. Sometimes that's powerful. Doing things over time. You saw how God has things over time. That's pretty powerful.
Yes, sir.
Those you have set up like that.
I have 4, 5.
You might try EVAs.
EVA.
You know, theoretically, EVAs should be more powerful than return on capital. Because you're looking at return on capital minus cost of capital. So return on capital, you say, wow, I got a high return on capital, but they may be a really risky company. But with EVA, you say, well, you have a high return on capital, but your cost of capital is high. So it adjusts the risk and returns. It's like the ultimate number. The downside of EVA is relying on Bloomberg calculator. Yeah, you can do that average or median EVA, change in EVA. I like the change in EVA a lot.
Change in EVA.
So you just go off to the far right and do EVA today versus 2 years ago or something. Do you have other things out to the right? Have you done kind of multi-year?
I've done this one just over 8 years. 6
How do you
years.
have it in the rankings?
In the ranks, I did the
The
average.
rank just ignores those columns?
Yes, sir. It
Okay.
just takes the average column.
Yeah, I usually put stuff like that over the right and then just that average in there. That way my ranks always go column by column. I mean, that's fine.
I see.
If you want to do EVA, you do 3 columns.
Okay.
To bring in.
One
If
column,
you put it off to the right, it's
some space, some, sir.
well, I mainly do enough for space, but mainly just, I want my rankings to go right more than the columns.
Yes, sir. Should I, well, I'll work on the formatting later.
Just whack EVA. EBA is great, right? Control capital minus cost of capital. It's a wonderful.
It'll work. Yeah. Over 3 years?
I would think. Well, the further back you go, the more days you can get. But why don't you try 2020, 2017? Copy the format from over on the right. Unless you want to talk about it. You can if you want to. You copy the gross margin and those. I'm just copying this. Control C.
We got a number.
Yeah. Copy that over. Well, I think you've got a error in format.
I think it's waiting on the previous or prior year.
Okay, row 3 should be row 4. Let's see, 4. Yeah, you need to have them in the exact same order you have them on the other columns. Or you have to get in a go into the gross margins. That's not enough. Oh, I see. That's that bold formula.
Yes, sir.
So copy. Yeah, go back over to the right. Make it 2017, 2018. And go back to gross margin, make sure it's 17, 18, not 18, 17. Yeah, okay. All right, so copy that down. Now into the 2020 and 2021. Where did you grab that formula from?
Yeah, I grabbed it from gross margin. I think I grabbed it from AZ6.
Yeah, I'll see what he's done on that formula. And that's the formula.
Yeah.
Well, it's that one, but it's also asking in 2017 doesn't exist. I mean, 2016 doesn't exist. So it's asking me 2017. Yeah. It's using that function multiple times, but it's like, hey, I looked at 2016 and it doesn't exist. So I looked at 2000. Yeah, I want to use 2016 but it doesn't exist. So I'm like,
years, multiplied the close years.
yeah, but we also have 3 years, so it's like 12. Well, I think it's the other. So if we did have 2017, we get 2016, but in that case, we don't really. I think actually what it's doing is seeing 2021 and 2020. 2021 are going to exist in 2020, and we can create 2017. And 2021 exists in 2021. It's fairly involved function. Any numbers in that?
Yes, sir.
I don't know what the zeros means. They've got something going on there.
Oh, here.
Some formula column.
I think they're just NAs for this year.
Yeah, I don't think 2021 is.
Yes, sir. Should we go back?
Yeah, just get those down. All right. Do you have any zeros or any of those?
There's one. Or
Yeah, I would, if I were you, not use 0, 0 on that one. I would have like -50 or something.
okay.
Because You want to be obvious, that zero can actually be pretty good. That's space version. You just space it. Convert to a text.
This one, where are you seeing that, Professor?
Right where you already fixed it.
Oh, here. Oh, sorry about that. Hopefully,
Copy that now. Oh, yes.
yes, sir.
Right, let's try it, and just see, so over, data column there, somewhere. Not there, but on the left.
Oh, I see. Over here.
Keep going out there. Where you're ranking, where you're ranking. Right there, yeah. Change the EVA. Equal, no minus, right. We're going to do 2020 minus 28. Find it, add it over on the right. Just copy the old. Just copy PQ over BJ. Yeah, that's just copy over. It's BJ.
Oh. Let's see.
Right. Oh, you got to change the BJ to BK. So you should have logged in the BJ.
Oh, okay, I see.
All right. After zero, minus all. I kind of like with this ratio. Yeah, you should just go. Oh, that's good.
Yes, sir. Oh, yeah, 6%. That's good. No return on asset, no net income growth. That's pretty good. That's not bad. Just this one. So I should shift these over to the right.
I just think it's
Easier.
It's just easier to have all your ranks right next to each other. It's not required, I've seen it done like that before. There comes a point where you have to roll pressure to do that because you want to change something, you just want to copy it over and you can't copy it over because it feels it's columns and there. So it is easy enough to just cut and paste them over and then get rid of those columns. Is what's perfectly fine to do.
I'll do that after class. Can you take us through getting the buy sell list?
Yeah. So up in CD1, somewhere, CD. Well, actually go down the CD, 5.
Oh, no, you did one difference.
Just do difference. Okay, do difference. All right, so you wanna, I suggest that if it's a positive number, that's good. If it's a negative, then it's bad. So do minus the 178 plus the 98. So it's a positive 2, so that means it's slightly cheap. You rank it 178, it's 188 is most expensive, so copy that down. The second one's a little expensive, you rank it 180. All right, so go to who's your number 1 stock? Here's column DZ, number 1.
It's all the way at the bottom.
Oh, I tell you what, do one more, no, you gotta do one more thing. At the bottom, you might not have done this in yours. So insert a column in CA. Right, this is something, Bon, I can't remember if you did this or not, but you want to rewrite fundamentals.
Okay.
And you want to rewrite the values. So rewrite fundamentals. Equal rank. 178 click on that column. Lock it in.
Walk in.
Comma 1 at the end. So the only way you'll have a company number 1 is if someone was writing number 1 all the way across. And that's just now let's see. Someone's doing number 1. You have it kind of sorted in a way that there is, you know, use that.
Fortinet.
Never heard of it. All right, so there's another one. All right, so now you want to do the same thing. You want to add it in column CD, or yeah, add a column. You want to do the same thing. Did we do a rewrite on yours, Bob? So that's something we definitely want to do. See all our rewriting? Why? Because if a firm rank like 2, 5, 7, 8, their weighted average rank might be like 17. But that might be the best one of all. So 17 might be the number 1. So you want to re-rank it so whoever has the lowest weighted score is actually ranked number 1. All right, so now you're going to go do that difference column. Go over to CD. Here's your most expensive stock. Okay, you got a problem with, there's definitely a problem in yours, so we got to fix that. You got too many number 1s. So that usually is a case. Yeah. No, go to the left. Why do you have all those number 1s there? Why do you rank number 1 everywhere? Oh, it's because they're just expensive. Okay, and that's okay. All right, and that's okay. Sorry. Go back to the top, and then the difference column. Now you're going to use those new columns. Look at that 104. Let's see what that. All right, that's not very good. You rank it 228. That's 2313. All right, let's go up and do by list. Go up to the very, very, very top. And then CD1, type the word difference. And the next one, type, I would do it to the left. So in CE2, I would type CE2, CE2. I would type quality. So, how many companies do you have?
31.
All right, so let's make the difference 10, let's be aggressive. No, let's make the difference 50. So we want to be a big difference, you know, guys. You know, quality, let's put them in the top 100, then make them like in the top 30. Type 100, so over and type 105, CE 5, buy list, or whatever it is. Next column, next row. Oh, yeah, you can do sell and all. All right, so the equal if the difference is greater than or equal to 50, I mean less than or equal to 50. No, greater than or equal to 50. Locking that. Yeah. Yeah. CA 6 less than or equal to 100. Power 1, 0, power 0. I think it's CE4 of the sun and that was it. 29, that's a little much. So that would make the difference 60 and the quality 80. Let's go find some. Eventually you can just sort it on the top. So you rank it.
Twillo.
Oh, okay. Go back over there. You want to make sure you get it right. So you rank it 46. It's 89 most expensive.
I think we rank it 41 and it's 130.
Well, you want the re-ranking, right? Which one's the re-ranking? So CA and CC, right?
Yes, sir.
Yeah, man, I looked really, it was a good podcast on them. All right, so you want to do your sell list, it's the same way. We still got too many companies, but that's all right. That's pretty good. Oh, no, do the whole list. So you have to go up to the top. So that's your buy list. So your sell list, let's say we want the difference. Say 10. No, just type the word. Just type 10. CG1 type 10. Always type 150. You can change the values. All right, so all this, the same formula as before, equal. The fundamental with the value is re-rank. No, the difference, sorry, the difference is greater than re-rank less than or equal of the fundamental re-rank. Less than or equal to 150. Actually, I can go comma 1. Comma 0. Minus what's in C. Otherwise, you'll get a 1 in both. I see that. All right, so put a sum up at the top of that. Only you have. Now, sell is really easy. Sell, you just do +1 minus +1 minus that should be like what, we have a company or something. Right, so and if you want to, you can certainly sort it by column CD and get those ones at the top. Select the whole thing and sort it. Do that. Or is this small? We're all the way over to CJ. CD is what you want to sort it.
Okay.
Red columns. So highlight everything we want to sort with CD. And we can highlight them on sort. So, did you do CE or CDOT? No, why didn't you do it? Well, I don't understand that. Something strange happened. Try it again. We have a That's true, yes. It's good. Go back over to the right. Up, right. Click on that button. Click on CD6. What happened? The difference is 62. That's good. Top 80. So why isn't that a 1? I don't get it. Am I missing something? Didn't I have a 1 right there?
Good. Yes, sir.
Something that didn't get locked in. Rerun. Difference. What everything looks right. CD6. CD6 is greater than CF1. Yes. CA6 is less than 80. Yes. Equal 1 is less than 0. Hit enter. Boy, I don't. All right, I'm really confused. What happened?
Not sure. Not
Boy,
sure.
are there any? We have 7 ones. Go down and find a 1 and we'll see if they can figure out from there.
Are they all at the bottom? Are there any ones?
It said 7. There's 1, right? The difference is 62. That's good. And that's not in the top 80. Why did we give you? No, wait. It's column. Which column is it?
5. So
CA. Yeah, CA is, that one works, that one's right. Why not? No, it's next one. Okay, go back up to the top, there's something for it. I don't understand that at all. That should be a 1 right there. And it did rank it as a 1.
yes, sir. Earlier.
So how did it, I mean, how did it sort it? I mean, how did it sort it? If it's a 0 now, I don't, wait, you sorted it on CD. There's something obvious we're missing, but I sure don't see what it is.
Should I not have selected this 5, row 5? Either way, it would have.
Oh, where's row 5 in there? Go back up. You should have row. Wait. Go back on the formula. Yeah, I don't think. Those are all 6s. I don't see a 5.
But this selecting it in the sort doesn't matter, right? Or it shouldn't matter.
Well, let me see anything in there from CD6 greater than 60. Yes. CA6.
This is
Go back
under
to that again. Look like the numbers changed.
everything. Well, has to repopulate, right?
Go back to that again. Go back to CD6. CD is definitely greater than 60, the CA is greater than 80. I mean, less, it's gotta be less than 80. It's not, so it's not in. There's something wrong with your rewrite function. Go over to that function there. That's right. Try to rewrite on the values to make sure. There's somewhere where you've got a problem with not locking something in. Rather, go ahead. What do you think? I think you see it right there. Yeah, we see it. There it is. Those ranks have to be locked in.
See,
Yeah, you may want to undo it back to where you started with the ones. Yeah, all of your ranks have to be locked in. So this may change your R squared quite a bit. So we'll see. Yeah, if you don't lock in the ranks, then that may explain why they're getting all those forms. Yeah, so make sure that's not the K, but the 336 has to be locked in. The 6 and the 236 have to be locked in. Not the K, don't lock in the K. Copy that now. Copy that over too. If you want to. Okay, now.
all the way.
They're all, make sure they're all in order. And you just go right, okay? Just go right. Okay. Switch the right arrow, okay? The right arrow, L, M, O. Yeah, you can pass it over. Right. Well, now, let me count it. It's gonna be really important. Don't keep going left and make sure they all are locked in. Yeah, okay. Now this is going to change. Go look at your R squared. This is maybe disappointing.
Uh-oh.
Yeah. All right, rerun your solver. Sorry, but it's good to find it. We're getting up into the 50. Yeah. All right. All right, so you have to do a little more work now. That's kind of where our tech models have been in the past. That's what we do. I mean, that's kind of a nice thing about doing the sorting, because you'll find those things when you sort. All right, no problem. Fernando, just a little more work to do. But the ranks, you might not. I mean, you've got it ranked. You got the buy and sell now.
Should we try to rank it again just to make sure everything's okay, or sort it? Really?
Well, it's, look at your graph. What does your graph look like now?
Oh,
yeah, it's not nearly as strong. I think I would add some more factors. This is kind of our typical tech model. You're still a little better than most tech models when they start. Reader cells, that makes sense. That's usually pretty high. I think about, why don't you work on it some this week? And one thing, adding some more of those multi-year things would certainly help. Things like earnings growth, not just sales growth, would be really good. You got a net income growth. We didn't allocate it. I'm surprised there's nothing in the default ratio. Go down one on that one. Comma one. So make sure you got the comma ones and comma zeros after it. It's probably comma zero. EVA is comma zero. Right. So EE, UVA, all those are all on zeros, right? On DE. No, those need to become zero. All right, this is kind of radical. Sorry, man, you know, this I haven't said.
I'm glad you did, Professor.
Yeah, those have to be zero.
Okay.
Because what we want is the most expensive stocks rank one, and you want to see that's the same as the common ones. Now, boy, you can get from negative for this.
I hope not. That would ruin my day.
I'll run to equal the cells, make sure you get cell this comes in. Okay. Well, didn't mess up so let's solve it. Yeah, I don't really understand that. Just double check that you that from BX that really is the right one. So your EV equivalent is P is going to the right. Yeah, that looks right. Yeah, this is one of the every Excel has errors in it, so this is how we find them. So now we go. I'm surprised your correlation stayed up. So let's go to your 60% doing BZ versus CD. That's still fine. That's good. You don't need to switch. You don't want to switch to the rewrites. It's still good. Look at your graph one more time. You definitely have some outliers you could kick out. That could help you some. So you might, you got that difference column? So you might go down the difference column and any huge differences. So you might decide, and let me show you how you can do it. So here what you might do is go back and resort, but sort on CD. This is a really quick way to select everything and sort on CD. What do you say, CD? One difference, right? It doesn't matter. Large is small, doesn't matter. So let me show you a real quick thing you can do. Go over to the right. At column BZ, click on BZ. That one row, and hit your shift, hit the arrows, right, go right, go over to CD, go highlight all of that, BZ. Come down, let's go down to 150. We don't want a different score anymore. So all you need to do is just click delete. I go down to the very bottom. Same thing. So you don't need anything more than 150. That's not going to do as much. Now look at your bar score and see what you got. 77. That's much better. That's almost back to where you were. Now the question is, what did you just delete? Now look at your graph now. Now rerun solver. Rerun solver. Now look at your graph. So look a lot better.
It is better.
So that's, I don't know why you saw that one, but that's the easiest way to get rid of the outliers is in that difference column, sort by that. And you just, the worst one you get rid of, like, real quick. You just went from 50 to 70. Just like doing that. All right, we're learning a lot. We're doing good. You're doing a good job.
Thanks, Professor. Yeah.
This is like, man, it's giving me memories of my Excel where there's always errors in Excel. So we found them. That's the good thing is we found them. So,
yes, sir.
all right, save that. You can work on a little more. You might bring in a few more factors. My only concern is what did we kick out? So you might look at the ones you kicked out and see how large they are and see if we can avoid kicking out any major. All right, good job.